I think it's time, and we'll get started. I'm Kathy Allen, one of the members on the council. This is my first time chairing, so please excuse me if I don't get things right. So we want to start with a roll call and do it.
Governor Michelle Lujan Grisham, Land Commissioner Stephanie Garcia Richard, Treasurer Laura Montoya. We are told that she's going to be late. DFA Secretary Wayne Probst.
Present.
Nick Teas.
Present.
Catherine Allen.
Present.
John Bingaman.
Present.
Kelly O'Donnell.
Present.
Alan Sanchez.
Present.
Kurt Summer.
Present.
Mary Roman.
Present.
That's 8. We do have a quorum.
Okay, thank you very much. Next is approval of the agenda. Do I have someone that will make a motion?
I move that the agenda be approved as presented.
Thank you. A second?
Second.
All right. All in favor? Oh, no, we have to do roll call, right? Yeah.
Treasurer Laura Montoya. DFA Secretary Wayne Probst.
Yes.
Nick Teas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
I can't hear you.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
Mary Roman.
Yes.
That's 8 in the affirmative. Motion passes.
Right. Thank you. And last is the approval of the minutes. And I understand we don't have to do a roll call. We could just, all those in favor of approving the minutes of the November meeting, say aye. Aye. Any opposed? All right, thank you. That passes. We're ready to go to the next report. So John Clark, you're the SIO briefing.
Thank you very much, Madam Chair and members of the council. This morning, you're going to hear a presentation on housing affordability. And I just want to note that a little bit later this morning, you're also going to get a presentation on a private equity investment that has a portfolio company that is manufacturing homes more affordably. And so this is one opportunity where we're able to leverage our resources to help address the housing situation in New Mexico. I know it's just one small piece of the puzzle, but it is an example of the sort of thing that we look for to see if there are ways that we can help address that. I want to give a quick update on the budget and the legislature. We put in a request for a 50% increase in our staffing budget for next year. And the executive branch, the governor's office and DFA, recommended that amount, a 50% increase. The Legislative Finance Committee recommended a 36.5% increase for us. Even though that's lower, that's still a pretty significant increase, and it's remarkable given that the overall agency budget increase LFC was recommending was 2.5% across state government. So this really shows that they are recognizing the incredible need that we have here to ramp up staffing. We had our first budget hearing, first of 2 budget hearings in front of House Appropriations recently. And the House Appropriations almost always takes the lower of the two budget recommendations. In this case, they told their staff, we don't want to go with the lowest. We want you to come back with a recommendation of something in between the two. So we should end up with something approaching a 43% increase in our staffing budget for next year. So that's phenomenal. In addition, want to highlight this report that you have sitting in front of you. It's our 2025 Strategic Venture Capital Program report. We also included a link to this electronically in Charlie's most recent email, but also this is available on our website. And it's about a 60-page report. I really want to commend our communications and marketing team for putting this together. They worked with some of our ecosystem partners to get this out the door in a remarkably short period of time. And this is really our first significant report detailing this program. I also really want to commend the private equity team for their work to build this program in the first place. And this report is receiving a lot of attention, publicity. There was an Albuquerque Journal article about it over the weekend. And a lot of our ecosystem partners have posted on social media about this report. One of them came back and told us, we've had over 50,000 views on this post. So really phenomenal. We're getting the word out about this program. In addition, the legislature is paying attention to this program. They're seeing how SIC's investment resources are able to catalyze new investments into New Mexico, companies coming in, companies expanding. And while we don't weigh in on broader state policy that goes beyond our doors, it is interesting to note that partly as a result of the activity they're seeing from our office and our investments, the Senate Finance Committee is considering a $1.2 billion proposal to ramp up all the other sections of the entrepreneurial ecosystem to match the investments that we're putting out into our fund managers. So this is really a remarkable show of support, and it is incredible that legislators on both sides of the aisle and in both houses are seeing the benefits of the investments that we're making here in the state. So really want to congratulate our private equity team on that. And thank you so much as well to council members, because a lot of this is possible because of the changes you made to the program last year. And with that, Madam Chair, happy to stand for any questions.
One question back. What is the amount that the legislature is recommending for salary increases across the board for public employees?
Sure. So, Madam Chair, at this point, the legislature is looking at a 1% across the board salary increase, but the Legislative Finance Committee in their budget recommendation for us explicitly said in their write-up that they want to make sure that we are paying market rate. So that increase that they recommended for us is both to hire additional staff, but they made it abundantly clear, both in writing and from remarks from legislative leadership during our presentation, that they want to make sure that we are both able to bring in the best people, but also that we're paying our current people appropriately.
Thank you. All right. Any questions from the council members? Seeing none, let's go to the staff briefing with Tom Lofton and Greg Dunn.
Good morning. Just Greg Dunn today. So I'll talk a bit about, as I do, about public equity market performance. We'll touch on a few macro highlights. I'm going to talk a bit more about performance since we just ended a year. So we'll talk a bit about 2025 and how 2026 has started. So 2025 was an interesting year for public equities. International stocks outperformed domestic for the first time since 2022. And it was the first time since 2017 that international stocks outperformed in a bull market. So a pretty significant shift in market performance leadership, which I think we should all view pretty positively. It's good to see a broadening out of performance beyond the concentration in large cap U.S. growth stocks. ACWI-X US, the ACWI-X US index was up 33%. So that's the broad international index, also includes emerging markets. International small caps were up 30%. The emerging markets index was up 34%. Some of the strong performing countries, China was up 35, Brazil was up 50, South Korea was up 80%. So there was some clear pockets of leadership, but it was really broad-based, strong performance in international markets. Returns were not as strong in the U.S., but still very respectable. S&P 500 was up 19%. Large cap growth outperformed value by a small margin, up 19% versus 16%. Small caps were up 13.5%. The Mag 7 was up 25%. So Mag 7 still did lead domestic performance, but by a much narrower margin than what we've seen the last few years. So last year, or rather 2024, the Mag 7 was up 67%. The S&P was up 25%. In 2023, the Mag 7 was up 107%, and the S&P was up 26%. So that Mag 7 leadership is narrowed a lot, and the Magnificent Seven trailed the international markets in terms of performance. So a bit of rotation and changing leadership. Interestingly, at the end of the year, in the October-November timeframe, in November, I talked a bit about the little bit of a correction that we were in at that point. That bottomed right around Thanksgiving. And then coming out of that, we've seen a pretty strong rally and a rotation in that leadership. So that rally has been led by small caps, both domestically and internationally. And so I think that's an interesting shift as well, where we're getting this broadening of kind of economic prosperity, if you will, beyond just the large cap mega caps. And I think that's a good thing for a portfolio like ours that's very diversified. We balance our exposure between domestic and international. We make sure we always have small cap exposure. We try to have a pretty market neutral approach. So regardless of what leads the market, our portfolios have an opportunity to participate. I think part of what's led to this rotation between international and domestic and small caps and large caps is the relative value proposition and growth prospects of the companies. So just taking international versus domestic as an example, looking out 1 year, analyst expectations are for 11% earnings growth for international and 14% earnings growth for the S&P 500. So that gap of growth has really narrowed, while the valuation multiple has stayed pretty far apart. So S&P is trading at 22 times forward earnings. International stocks are trading at 15 times forward earnings. So I think that's a big driver of why international stocks are starting to close that gap. You've got to have the growth. Now they've got better growth, and they've got a much better valuation multiple tied to it. So it'll be interesting to see how what the persistence of that rotation is. It's only been a few months, but I think it's an interesting development. Briefly on macro, when we last talked in November, employment, inflation, and consumer sentiment were trending negatively. Those negative trends appear to be improving somewhat. So the most recent CPI data for December came in quite a bit lower than expected. Core CPI remains around 2.7% year over year. The unemployment rate is hovering around 4.5% in the U.S. Average monthly non-farm payroll gains during the year were only 49,000, which is pretty low. Generally, when we've got a healthy growing economy, we see 100 to 200,000 new jobs a month. So we've been well below that. But I think there's probably some reason to believe that inflation and employment will compare favorably to 2025 in the year to come. The peak impact of tariffs seems to be behind us. Doge layoffs are behind us, and the stimulative aspects of the tax cuts from the one big beautiful bill should be a bit of a tailwind in 2026. Internationally, the current administration's geopolitical tactics have seemed to be a catalyst for more stimulative policies and investment in growth by governments abroad in an effort to be less U.S. dependent, whether that's in regard to trade or defense, among other things. So I think that's has been and I think will continue to be an interesting tailwind for international public markets. With that, I'll take any questions.
So, thank you for your report. Question on the unemployment, because we're seeing massive layoffs on a lot of the large corporations that are regular hire because of using either the excuse or the reality of AI. So I worry about that catching up and impacting the employee, because it's going to impact consumer attitudes as well as spending. So that's one pocket. And then the other pocket is looking at possibly tax returns or increased tax refunds, and how that might impact the economy. I just feel like and then you see credit card delinquencies are higher than they've been for a long time. Car loans are higher than they've been for a long time. So I feel like we have mixed signals in the economy. And I know we're doing the right thing by being diverse in terms of but it's just hard for me to see that it's going to be a great year when you see all these other factors in there.
And I wouldn't say I would expect necessarily a great year. Following on the performance we had last year in the public markets. And you're right, there's puts and takes. So for this brief report today, I focused on some of the more positive ones, but you're right. There's affordability is still an issue for a lot of consumers. We've seen that inflation slow down, but it's still affordability is very much a headwind. The tax cuts are looking to be a bit of a one-time, in some ways, a one-time kind of stimulus because it's retroactive to last year, that people's refunds this year will be on average like somewhere between $1,000 and $2,000 more than they would have gotten otherwise. And if we know one thing about the U.S. consumer, it's when they get money, they spend it. So that's probably going to have a stimulative effect on consumer spending. The AI and its impact on employment, it's hard to discern yet what that impact really looks like. We do see, we certainly see pockets of layoffs that grab some headlines. I think the adoption and implementation of AI and its ultimate impact, we can kind of imagine what it's going to be before it can actually be fully implemented. So I think it's going to take a few years, if not several years, before we can ultimately kind of make that assessment. But it is, it's a headwind especially to, those high paying jobs in our economy.
Okay, thank you.
Yep.
Any other questions from the council? If not, thank you very much, Greg. Appreciate it. All right, now we'll go to portfolio recommendations to the performance report. Nino Carpentino.
Better? Is that better? We're here to present the monthly performance report for November. Please keep in mind that this is a public market update. So you'll see public debt and equity. Next month, we'll have the fourth quarter report. That'll include all of the asset classes, both public and private. With that, I'll turn it over to RVK.
Thank you, Madam Chair. Thank you, Nino, for the remarks. We do have your November performance summary in your materials. We'll talk a little bit about the market environment, although November at this point likely feels a bit dated, so we'll try to give you some more near-term updates as well. Director Dunn did provide a good overview in terms of what's been driving the markets as well as what's been happening in the equity portfolio. Madam Chair, you touched on the mixed signals. I think that's a theme throughout all the economic indicators that you look at. And in part, the result of, I think, what we're largely, and it's been described often as a K-shaped economy, where there's a very differentiated experience based on your income, your overall asset levels, and those that are materially invested in terms of their assets in the stock market obviously are doing very well. And those that are living more paycheck to paycheck, obviously feeling the lingering results of inflation and rising costs and uncertainty. So I think that is a large driver of some of the mixed signals that you're seeing domestically for sure. And as Director Dunn mentioned, the U.S. consumer is fundamental to the U.S. economy. When you look at GDP, we've mentioned this a number of times, consumer spending makes up about 2/3 of that. So when you have a healthy consumer across, not just at the very top, you tend to have a more healthy economy, and that's not something that we're necessarily seeing. But you're exactly right. I think the continued upward trend in the markets has sustained some of these metrics perhaps longer than we would have otherwise. But there's still a fair amount of uncertainty in terms of AI and what that does to jobs, even high-paying jobs, software, and how those individuals will get retrained or rotated into other roles that can certainly add value. I don't think it has to be binary where it's you're employed or unemployed. I think it's more about how those jobs will change over time, and the compensation, of course, may change. But you're right. There's a lot that could happen as part of that, and particularly domestically, quite impactful. If you look at your November report, and we look forward to bringing you the year-end report as well, I think you'll see returns that are quite favorable on an absolute basis. Of course, we've had a roaring 2025, so it shouldn't be a surprise that the numbers are quite attractive. When you look through year to date, so those 11 months in 2025 through the end of November, the land grant portfolio was up 12% or so, and then December added a bit more. U.S. markets up another % in December, plus or minus. Non-U.S., which has been leading all of 2025, up even more, 3% in December alone. So a strong finish to the year. And fixed income markets, well, there's been a decent amount of volatility in terms of rate movement. The actual return was reasonably flat in December. So we should see that 12% move up once all the final marks are in, and does mark another strong year overall. And as we said, that's in the face of a prolonged government shutdown, inflation that has eased but still relatively high, and some unemployment concerns as well. So capital markets have pushed a lot of that aside and have just moved higher. We are actually in the process of working through our 2026 forward-looking capital market expectations. You'll know that we bring that to you during the spring macro season, and we look forward to bringing that to you in the next couple of months. That, of course, informs asset allocation and expected return and risk measures as well. And so we'll see what the impact of that will be, but largely coming off of an exceptionally strong 2026, we are likely moderating our expectations, given that we had major double-digit returns out of a lot of the particularly publicly traded assets. these last few weeks, and it's been probably longer than a few weeks now, we are, I think, reminded that the policy headlines do move markets and can move them materially and quickly in both directions. There is, of course, a lot of rhetoric that I think is intended to make headlines, and I think markets are reacting to that. When you have valuations at the levels that we're currently experiencing, of course, markets are more susceptible, investors are more susceptible, and paying closer attention to these types of headlines, and so I think we have to be overall mindful of that. So Greenland and the potential trade war that could escalate from that, for example, was a recent one. Now we've backed off of that. All that to say, I think that the level of volatility that we've seen more recently is likely going to stick with us for a while. Fortunately, you've been very diligent to thoughtfully build a portfolio. Again, Director Dunn mentioned you have strong diversification, not just in the equity portfolio, but throughout, that really is designed as an all-weather portfolio for this type of environment. You're not just built to do well when equity markets are doing well, but you've got lots of downside protection. Then you have some systemic tailwind built into the portfolio as well that will continue to help. You have a positive cash flow profile that most other funds can only dream of. That's another benefit that I think will help, but I think it will certainly take a close watch and good collaboration by your staff and partners to make sure that the portfolio continues to remain aligned both to the policy targets that you've set and to opportunities and risks that this market will surely provide. In terms of your fixed income portfolio, I've mentioned likely that you do have a bit less interest rate risk, so you're less exposed to major moves in interest rates in your public fixed income portfolio. Duration, it's a measure of interest rate sensitivity, is 4 relative to a benchmark of 6. All that to say, about 2/3 of the interest rate sensitivity that the broad market has, and that's certainly helpful when rates are jumping around. You tend to have a bigger focus more on just driving income and yield relative to rate positioning, and I think that's a helpful place to be in this current environment. Your global equity allocation, and again, Director Dunn, I think, alluded to this, has been quite helpful. In this last year, you outperformed by 1.5%. That's, again, due to how you're positioned. You have far less of a home bias, so essentially saying that you're not as heavily allocated to U.S. markets as a lot of your peer plans across the large plan universe. You're much more valuation aware and not just chasing whatever's doing well. And that foresight has really paid off as international markets have just done very well for the tailwinds that have already been mentioned, and of course the dollar, which boosted those international earnings over the past year plus, and we've continued to see a decline in that. That's helped really any non-U.S. asset over the last year or so, as we've seen that softening dollar. So overall, we do think that you're adequately diversified and as well positioned as you can be for this type of environment, and again would expect this type of volatility to persist for this year, and we're certainly looking at it, and we'll bring you any concerns or opportunities as they present themselves. So I'll pause here. Happy to take any questions. Otherwise, I think Marcia has a few comments on the portfolio results.
Thank you. Excellent update. Any comments or questions?
I'll be very brief. I'm just going to show the proof of what Director Dunn and Matthias spoke. First, on page 21 of your report, I do want to just point out that you are in a good position with your asset allocation across the board. This page is looking at the 3 funds that make up about 88% of the total funds. All 3 of these funds have interim allocations, and as we've discussed before or talked about before, it takes a while to build up your, to get to your private target. So that's why they have interim targets. But you can see you're very close to your interim targets. The assets that will be funding the private investments are being held in cash and to a certain extent and in your core fixed income, as Matthias just pointed out, that your core fixed income piece or your public markets fixed income is designed to have lower interest rate sensitivity, so you can see some overweights there and overweights in cash. But again, that's pending commitment, honoring your commitments on private equity. Do want to also point out on page 24 briefly that the behavioral trust, you received $100 million to manage. That has been invested now. As of November, you can see an allocation there. And then on page 26, again, this is calendar year to date through November, but you've had contributions of about 3.9 billion. Your distributions have been about 2.4 billion. And at that point in time, you were at 68 billion in market value. Page 28, this is looking at the performance of your funds. As Matthias pointed out, your calendar year-to-date returns have been quite strong. If you look down the performance of each of the funds, you'll see that it ranges between 12.8 is your highest return, and to your lowest return with tax stabilization of 6%. Again, that is just a factor of asset allocation. The tax stabilization is fixed income, and the other funds that have equity in their portfolio have been performed around 12% for the calendar year, so for 11 months of 2025. Lastly, just to show what Matthias was speaking about with the performance of the public markets, again, I'll focus on calendar year to date on page 31. The global equity, Matthias mentioned, over 1% above its benchmark of the, if we're looking at global against the world, MSCI, all country world, your combined U.S. and non-U.S. equity portfolio returned over 22%. Again, you don't have a home country bias as many of your peers do. That served to your advantage in this time period where non-U.S. equity markets did quite strong. Below that, you can see the return of your U.S. equity portfolio and your non-U.S. equity portfolio. Again, to Director Dunn's point and to Matthias's point, non-U.S. equities outperforming U.S. equities, but both very strong performance for the year. And lastly, because we only have public markets here, you can see your public market fixed income for calendar year to date up 7.4% on a net of fees basis. So all in all, doing well with your asset allocation, and your performance has been on absolute basis very strong, and even on a relative basis as well. With that, I'll take any questions. We will.
Madam Chair, excuse me, I have some questions, please, or some comments, really. It's Member Roman. One is that I think it's very significant that the state of New Mexico was upgraded, its bonds. I mean, it's really a win for the state, and I want to make sure that everyone was aware of that it's important. And two, and perhaps Member Bingaman will get to this in the investment committee report, but we had a very robust discussion, as you'd hope we'd have, in the investment committee meeting last week about these headlines, this geopolitical risks, all of it, and they're huge, and they're many. And we're very used to relying on the credibility and the stability of the United States in financial markets. And I'm speaking only about financial markets. And one of the topics that came up was gold and precious metals. And I understand that it's not a typical holding in a portfolio of our size, but I do think that we need to look at it again. Not as an income producing asset, which it is not, and not as anything, and not as an inflation hedge, but as a crisis management holding in the portfolio. And even if we decide not to move in that direction, I'd like to know that we had the discussion, because there's no issuer risk, there's no duration risk, there's no policy credibility risk with gold, but it's something that we should look at. And it's not because gold is on a tear right now. It's just because I think it's a good discussion we should have.
Thank you. Any comments on that?
Yeah, I think that's, thank you, Madam Chair. I think that's consistent with the investment committee discussion. I think Member Roman characterized that quite fairly in terms of our view of gold. Certainly a store of value, but more importantly, a crisis hedge from our perspective. And as we had talked about, there's very few institutional investors of your size that have dedicated strategic targets or exposure to precious metal such as gold. It is found in various parts of your portfolio, either directly, like in some cases in your real assets portfolio, but then also more indirectly, some of the international equity markets through metal mining stocks and similar. No, it's not perfect. So I think it would be helpful, would be certainly happy to try and provide an overview of the current exposure for precious metals and gold specifically, and then talk about that in more detail with the broader group. So be happy to do that.
Thank you. Other comments from the council or questions? All right. That's it. Thank you very much. Excellent report. Appreciate it. All right, now we're going into portfolio recommendations and updates, and we'll start with the investment committee report. John Bingaman, who's virtual.
Thank you, Madam Chair. We did have a meeting of the Council Investment Committee last week. We had a robust discussion about the overall market risks. As Member Roman alluded to, reviewed the portfolio and how we're positioned there. We also had a discussion about our manager concentration limits and exposure limits, and reviewed that. And I can report to the council, we did confirm that our active and passive public holdings are virtually all, held in, custodial accounts, which I think helps us all sleep well at night, knowing that we have direct, ownership of those securities through our custodian. We did review each of the investment voting items that are on the agenda today and unanimously agreed to recommend those to the council. And that's my report.
All right, great. Thank you very much. And also, Brent, just note that the treasurer has joined us remotely. All right, thank you. Next is a discussion on real estate and affordable housing review with Keith Sobel and Townsend.
Thank you and good morning, Madam Chair. We're here to have a conversation about affordable housing, and I want to lead off by thanking the governor for the opportunity to pursue a very important topic, which is affecting the lives of many. While the deck contains a lot of numbers, we want to emphasize that we view this through a lens that appreciates that this is fundamentally a people issue. Joining me for the presentation today are Rob Coaches and a new face for Council, Malcolm Blake. I wanted to make sure that he was visible today because he did a lot of hustling for us in the period between Thanksgiving and January to make sure that this presentation would come together in an appropriate way. Over the slow season, we did a lot of research and tried to start with a clean slate to make sure that we had conversations with the right people to help us to gather data from objective sources to make sure that we could address the problem from a clean slate perspective and take a data-driven approach. From the perspective of data, we looked a lot at U.S. Census data, and I would call out also the Harvard Joint Center for Housing Studies and several other items which are cited in the index for the report. But all of this was designed to figure out how SIC might possibly play a constructive role in addressing the topic. In terms of conversations that were held, we had discussions with many of our GPs, at least 5. I would call out Fairfield as one of the managers who was particularly helpful in this endeavor, both with data analysis and also with their work here in the state. While they've not currently invested in the state, they have been quite active in conversations with Housing New Mexico and Izzy Hernandez team. And I know that they have been involved in bids on at least 10 properties here in the state. So their perspective has been particularly helpful. We also had conversations with the operating partners of our general partners. So those are the boots on the ground involved in affordable housing development. And so there were some interesting insights that were gleaned from them. We also took a different perspective and had conversations with WestPath, which is a mission-oriented LP who's been active in support of affordable housing for quite some time. WestPath, as you may be aware, is the sponsor of the Methodist retirement plans. And then again, here in New Mexico, we touched base with a number of local experts, Housing New Mexico, the team that I had just mentioned previously, NMSBIC, Russ Cummins, Ventana Fund with Todd Clark, and Washington Federal with Joshua Smith. Quick summary of some of the learnings from this process. One, there are a lot of experts in New Mexico, boots on the ground, who are spending time looking at these issues every day. Honestly, I would say they know a lot more than what the team here in front of you does, just different purposes of business. We found those conversations particularly enlightening, and I would highly commend each of those groups to you for future conversations. While affordability is a ubiquitous issue, in the data we reviewed, perhaps surprisingly, doesn't indicate that New Mexico is uniquely impacted relative to national averages or surrounding states. And that was a bit of a surprising outcome that we were able to identify in the census data. Another theme that's pretty prevalent is economics are driving behaviors across the housing value chain. It's a little bit of a statement of the obvious, but affordability is a function of cost, interest rates, and resources available. That's true both from the perspective of the homeowners who are trying to afford their mortgages, individuals who are renting, but also from the perspective of builders and other people involved in the supply side of the value chain. From a supply perspective, I think there's 2 points that we should recognize. One is supply can come in 2 different forms. One is the more obvious form, which is new units being constructed, but there's another component as well, and that's through the refurbishment of established affordable supply and extending the lifespans there. A solution for affordable housing will have to look at both of those angles. One of the things that was particularly interesting was a research report that had been written by professors at Notre Dame that was called to my attention. It's posted on the Minnesota Fed website. The research basically pointed to the idea that new supply added to the system at any point in the affordability curve will ultimately filter down into the more affordable segments over time. And so it makes it clear that playing the long game in affordable housing doesn't require a singular focus on affordability, but more broadly on developing supply anywhere in the system. And so I think that's an important and key takeaway. The capital markets also do play a role in this process. One that you'll see as a graphic in the presentation is interest rates, and they've had a very clear impact. But also from a capital markets perspective, in our conversations with developers, they actually said that they were not interested in our equity in their projects. The fundamental reason for that is if we provide new equity, we're diluting their return stream. And so that's essentially a counterproductive approach. The developers had indicated to us what they're most keenly interested in is cheap access to borrowing and typically below market rates where possible. And so that's a key item, I think, to focus on. From the perspective of best ways to utilize SIC resources, I think number one, we have a tremendous pool of capital. We have a very large stable of managers where we can be influential in conversations. And I think driving our managers to have conversations with the local experts is a particularly productive way to proceed potentially. In my introduction, I had mentioned that Fairfield has been active here, and they have reached out on a number of different occasions trying to work collaboratively to bring solutions to bear. I think that's probably the best way for us to proceed. A second avenue available to us here at SIC is cross-asset class collaborations, where we focus on matching the risk and return profile of the capital that we have with the capital needs that are expressed by parties that are interested. I will highlight that I've had conversations with Chris Cassidy's team on XGS in the early days, and American Homes is one of the portfolio companies that will be addressed later on. I'll be meeting with representatives of that company later on during the course of the week. And so there is an undercurrent of these kinds of conversations that's going on all of the time. I'll wrap up my comments here and hand off to Rob for the more formal part of the presentation. Thank you.
Okay, and I'm going just to remind everyone, and I did hear you well, just speak up for the recording. So anyone that's speaking, doing that. But could I just ask one question in your research? First of all, I commend you for the kind of research that was done. Looking at corporations buying homes, that I know in Florida and some states, it's been an issue where there have been a lot of corporate buying of homes, and that's driven up the price or taken supply off. Was that part of the research or anything you found?
We have looked at that, and I'll ask Rob to make some more in-depth comments. I think he has a little bit better command of the percentages there. I would call out that there are a couple of different parts of that story. One is private equity moving into neighborhoods and buying individual properties and consolidating ownership in that way. And then there are single-family build-to-rent communities where essentially the private equity funds are a source of capital that's an offtake in many cases for the builders, and those are actually helping to develop supply. And so I think we have to be very careful about which of those particular pieces that we're talking about.
Right. Well, yeah, good morning, Madam Chair and members of the committee. Thanks for having us today. We're happy to participate in this discussion. Our materials begin on page 49 in your book. I'm going to start on page 51. And I'll Chair Allen, I'll address your question immediately right off the bat here on page 51. Because the residential market in the United States is very large and diverse. It's not monolithic. So you have a variety of different formats, everything from single-family housing to high-rise apartment and condos in New York City and San Francisco, typical garden-style apartments, manufactured housing, which would commonly be referred to as mobile homes or trailer parks. You've got all kinds of housing formats in the United States, and a lot of things are relatively new and developing, which presents some interesting opportunities, but they're small, so it's difficult to scale. One new area that has been growing really since the global financial crisis is single-family rental, is how the industry refers to it. But in reality, if you look at the chart on page 51, 135 million housing units in the United States. The majority of those are just your typical single-family home that probably most of us in this room own and live in. But there's a significant slug of single-family homes that are just rented out, about 14 million housing units there. And the vast majority of those are just what we would refer to commonly as mom and pop operations, right? Somebody owns a second home or a third home, second and third home. They rent it out to a tenant full time. It may be a vacation home. They use Airbnb to generate some income off that. So the vast majority of that slug of kind of the single family homes that are being rented out are owned by individuals like us around the room. There is a growing portion that are owned by private equity interests, institutional investors such as yourself. That accounts for about 1 to 2 million units today. So out of the 14 million there, that's roughly it's less than 1 to 2% of the entire single-family housing stock, but it is a growing sector. And as Keith said, there are good sides and bad sides to that. Perhaps there is some possibility that the private equity interests are buying homes and crowding out typical individual home buyers. But on the flip side, that's the only segment of the market today where you're seeing a lot of single-family housing construction starts, is the institutional investors and private equity firms that are coming in and building to rent. Because the overall housing market, like we've talked about with respect to your real estate investments, has been stalled for a couple of years because of high interest rates. Transaction volume is low, and we're not seeing a lot of construction starts of just typical single-family homes today for sale. The only ones that are being built are for rent, and that's typically an institutional or private equity type firm. So that is actually contributing to supply. And one of the themes you'll hear from us today is that's an important component of finding some solutions here. But one comment to start with, though, is we're not recommending a single bullet today, or a silver bullet today, rather. There really is no silver bullet to solve the problem that we have. What we want to do is help define the issue for you as council members. We want to suggest some options that are out there, things that are being done by peers and including managers in your portfolio. And at the end of the day, I think, as Keith said, the best solution is really multiple efforts. A lot of it is relationship oriented, connecting people with folks in the state of New Mexico, with agencies that are focused on affordable housing, for example, with local developers that might have opportunities for investment, either to as you or your peers as an investor, or just hooking up local parties with some of the managers that you work with. So it's a multi-pronged approach without a silver bullet, really. But just to complete the story on page 51, as I said, it's a big non-monolithic market. It's very diverse, a variety of formats. And when we talk about affordable housing, one of the challenges is how you define that term. And everybody in the industry seems to have a different definition for what you mean when you talk about affordable housing. And what we try to do in this analysis, kind of cut through all those definitions and come up with, kind of three categories of housing in the United States. And one is market rate housing. That's colored blue in this chart. That could be either for rent or single family homes. On the other end of the spectrum, you've got government subsidized housing, which could be a variety of things. We'll talk about some of that later, but basically the single most important factor is that housing probably wouldn't exist without government subsidies. And then there's a category in the middle, which is what we call affordable housing, primarily for rent. And generally, when we say affordable, we're talking about low to moderate income individuals are renting that home. But in reality, up and down the spectrum, or up and down the stack of the housing universe in the U.S., you'll find that there are affordability issues really at all levels. And there's also a lot of overlap in these levels. For example, the single family rental is not all corporate America coming in and buying homes. It's really mostly people like you and us that are out there renting a second or a third home. So the next three slides in the presentation, we'll talk about, what are the causes of the problem that we have today? And there are really three: supply, costs, and interest rates are the three key components. And another interesting factor is that a lot of these things, the seeds were planted years ago. Some cases dating back to the global financial crisis. Some cases they developed over the COVID years, really since 2020. And you'll see that in the numbers. It took a while for all of these components or all of these factors to come together and create the problem that we have today, where you're seeing affordability issues up and down the housing stack. But on page 52 of your materials, on the supply side, the United States is still a solidly growing country. We add about 500,000 to even up to 2 million new households a year to the demand side. So every year, the pie needs to get bigger in terms of the number of housing units in the United States. But the supply side, the delivery of new units to the market, is very volatile, or can be very volatile. And in particular, since the global financial crisis in 2007, 2008, we saw a big drop-off in deliveries and new supply added to the housing stock. And across the board in the industry, the consensus is that that drop-off in supply has created a housing gap, if you will, between supply and demand of anywhere from a few million units to 5 million units of housing that the market needs in order to help stabilize supply and demand. And of course, if you have more demand than you have supply, that's going to push the cost of housing up. From 1990 through the global financial crisis, we added about 1.5 million units per year to the housing stock nationally. And then that dropped off significantly down to about 500,000 units. So we dropped 1 million a year for a few years. And it's taken really until 2024 to build that supply back up to that pre-global financial crisis average of 1.5 million a year. So that period you see in the chart on page 52 really illustrates that supply gap that exists in the market. On the next page, we'll talk about costs. And this really goes back during the COVID years. And the chart on the left shows it's an index of construction costs for delivering new apartment units to the market. And these are national statistics. This is not just New Mexico, but these are national statistics. And what you can see if you draw a vertical line around 2020, 2021, you'll see that the cost of adding supply to the market has increased significantly since COVID. And that was really the result of all the supply chain issues we had that created a lot of problems with materials. The labor side, labor costs increased as well, although some would say that immigration actually helped in terms of the labor side during the COVID period, and now that might be an issue going forward. If immigration drops off, that'll hurt on the labor side. But the bottom line is we saw a significant, about 20% increase in the cost of delivering a new unit to the market since COVID in 2020. And on the right-hand side, that shows up in home sale prices. These are just indices of sale prices, and that cost is carrying through to sale prices as well. So the cost to build is higher, the cost to buy is higher for everybody in the market. On page 54, we'll go to a chart which Keith found, which was really helpful, the what we call the affordability index. And that is the median average income person has enough income to buy the median home price in the United States. And when that index is at 100, that's considered to be equilibrium. So the average home buyer can afford the average cost home. And this chart, I would say a couple of things. There's a completely inverse correlation to interest rates evident in this chart. So as interest rates spiked in 2022, again, during the COVID period, you could see that the affordability index dropped off significantly at the far right-hand side of the chart on page 54. The interest rate increases don't just affect the cost of buying a home. In other words, the mortgage rates are up, but it also affects the cost of adding units to the market because interest rates go up for developers, and building houses is a highly leveraged activity. So again, it adds to the cost of new construction as well. And I think an important point to keep in mind is really since the global financial crisis, through the COVID period, we actually had in the market a period of kind of excess affordability. The Fed jumped in after the global financial crisis in 2008, started lowering interest rates significantly, and because of lower interest rates, housing became much more affordable for a long period of time. So we got used to having, 3% mortgage rates on our homes. We were able to buy more and spend more on a home because we could borrow at much lower rates. And that lasted for almost 12, 13 years since the global financial crisis. And the whole market just got used to having housing available at more affordable rates. And then all of a sudden, the Fed kind of took the air out of the balloon in 2022, and interest rates jumped, more than doubled during that period from 22 to 23. And that created the challenge that we have today. But we're really back to kind of an equilibrium when it comes to affordability, but coming off a long period of when housing was very affordable, it makes it feel like it's less affordable today. So the impact of all those things on page 55 is the cost-burdened housing or cost-burdened households is increasing significantly. And we measure whether or not a household is cost-burdened by saying that the household is paying more than 30% of their income on housing and housing-related expenses such as insurance and taxes and utilities. And if you're spending more than 30%, you're considered burdened as a homeowner or as a renter. And the chart on the left side of page 55 shows that the indexes here are all going up. And especially for renters, we're actually at peak levels of burdened households when it comes to renters in the United States, higher than levels we've seen in the last 25 years at least. And it's also going up for home buyers as well. And of course, related, the number of homeless are increasing, and that's why we say it's across the board. We're feeling it up and down the spectrum when it comes to affordability. Just one note about New Mexico on page 56. Keith mentioned this. Just a couple of factors suggest that you're actually in a better position here than the national average and some of your surrounding states. When we look at things like this cost-burdened housing, your level of cost-burdened housing is lower than your neighboring states and the national average. Your vacancy rate here, when it comes to rental housing, is actually higher than the national average in your neighboring states, which suggests there should be a little bit more cushion in your market. You don't have that supply-demand pinch as much as some of the other markets around the country. Now, the next three slides, we're just going to real briefly go through what are the industry responses. So how is the private market responding? How is the government responding? And what can institutional investors do to respond to the problem? On the private market side on page 57, as we said, the market is really kind of stalled right now. You're not seeing a lot of new construction starts because interest rates are high and the cost is high. The for sale developers are not selling units, so they're not building more units. So the market's pretty much stalled. But what the private markets are doing is they're exploring new formats and new methods of construction that will lower the cost. So on the method side, you'll hear some of that in your private equity presentation later. But there are a number of prefab or modular home construction companies that are building housing units off-site and transporting them to a site rather than building them on-site, and they benefit from the efficiencies and the scale there, and they can reduce the cost that way. There are some new methods of construction. There's a method called tilt-up concrete construction, typically used for warehouse buildings, adopting that for building smaller ranch housing, a little bit cheaper than lumber. And then there's a lot of experimentation with density. And I love the picture on the upper right-hand side on page 57. We looked at this deal for another client in Phoenix, and it's the most dense single-family rental community I've ever seen. It was built for low to moderate income renters, and those are all single-family homes, small homes on really tiny lots, a few amenities built into the cluster, but just putting a lot of them on a small piece of land, trying to get the cost down so that people can afford to rent those homes. And that's one example where the private markets are coming in with a new format that's trying to address the affordability issue. In terms of government responses, there isn't a lot new here, but there are efforts to increase supply. There are tax credits available. These are primarily federal tax credits. I should say all federal tax credits, which helps subsidize the construction of affordable units. People that are at 60 to 80% of area median income or lower. There is direct subsidies to renters or sometimes landlords. HUD, again, another federal agency, runs that program. That's just basically a direct subsidy to help low-income folks afford a place to live. And then there's a whole series of a variety of subsidies available at the state, local, and federal level, including local tax abatements, subsidizing mortgage interest rates, home down payment assistance programs. So you got a whole variety of different programs that are out there. Those are primarily organized at the local level and through state agencies such as the groups that Keith and we had some phone calls with. And then, finally, we are seeing a lot more discussion about just pure rent control. And right now in the United States, the United States is actually the most open market in the world when it comes to rent control. We have less of it than most other countries around the world, and at least most developed countries, let's put it that way. But we do see an increase in the amount of discussion and potential for rent control across the country. Right now, we track about 12 states in the U.S. that have significant amounts of rent control. Now, for institutional investors on page 59, what are your options? What can you do? A variety of options here. There are funds that you could invest in. You have already invested in some. And there are others that are out there that focus on things like new construction to add supply, funds that are targeted at more affordable or lower income individuals, renting to lower income individuals, or funds that are targeting some of these newer niche strategies in real estate or in private equity, as you'll hear later. The challenge with a lot of the funds that are out there, and we'll talk about this a little bit later in the presentation, but not a lot of these funds are paying a lot of attention to New Mexico. So you might help the affordability issue nationally, but it's not necessarily going to drive affordability in New Mexico. And we think in order to drive affordability in New Mexico, you're really going to have to do some kind of a structured or customized program that'll either work with local players here or push your managers to focus more on the state of New Mexico to get investment dollars here. We did add the column on the right, avoid the residential sector altogether. You could just simply not invest in housing, and you don't want to contribute to the private equity firms that are buying single family homes, et cetera. We don't really recommend that as an option, but it is an option that is out there for investors such as yourself. The next two slides I'll just cover real quickly, but there is a robust selection of funds that you can invest in the housing market. On page 60, the point of that fund is really to say, that page is really to say that out of all the funds that are out there, we're tracking 61 housing-related funds today. They've raised about $6 billion the last couple of years. You're invested in some of those. The challenge with those funds today is less than 20% of those funds are really targeted at affordable housing or housing that's meant to be rented or sold to low to moderate income folks. Most of those strategies are focused on market rate housing. There is a blend, of course, across those funds, but that's a challenge, again, if you want to focus on strictly affordable housing for low to moderate folks, there are fewer options available to you as an investor today. I would say that segment of the market is growing, and you'll see more opportunities going forward. But right now, it's still a small part of the market available to you. And on page 61, we show some just some performance historically, looking back at funds that we've worked with, that our clients have invested in over the last few decades, really. How have those funds performed? And the takeaway from this slide is, multifamily funds, especially multifamily rental funds, have been accretive to performance. Generally speaking, the performance has been good. When it comes to funds that are targeting more affordable housing, the results are mixed up and down the spectrum here. And we would say that there are affordable fund options out there, but you have to be very careful about manager and fund selection because the results have been mixed historically. And I'll give Malcolm just a chance to talk just a little bit about your benchmark and the component of residential in your portfolio and in your real estate benchmark.
Thanks, Rob. What I want to raise is that your real estate portfolio is substantially invested in the residential sector today. That's about 27% of that portfolio. That represents about $1.2 billion, and that's spread across a variety of funds. That's totaling 43 funds in the portfolio today. I'd also say that housing is just a growing segment of your real estate benchmark. Just a quick reminder that your benchmark is NCREIF Odyssey, and that's about $205 billion across 25 funds, so well represented across the U.S. real estate market. And I'd also add that generally, housing has been positive and accretive to portfolios for institutional investors. Looking at the chart below, over the trailing 5-year period, which as a reminder, that's your benchmark performance period, for unlevered NCREIF returns for apartments, the performance for the sector the segment of data that includes apartments was better performing than if you excluded apartments, and that's about by 40 basis points, which is greater than 10% of the total return for that 5-year period. So just a quick summation, your portfolio is already substantially invested in the residential sector. The sector is only growing, it's not going anywhere, and performance has been accretive due to exposure to that segment of the market. With that, I'll hand it back to Rob for concluding remarks.
Yeah, and it just, again, page 63 of the materials, no silver bullet here, but just to sum up, affordability is a challenge up and down the stack of the nation's housing. New Mexico's experience is not unique. We think that a lot of things could be done, a multi-pronged approach. You could do a number of things in the affordable sector, but it's not, you're not going to solve the problem on your own. But that would include, those multiple prongs would include, investing in continuing to invest in the funds as you have been doing, maybe focus a little bit more on things like new construction if you wanted to have a bigger impact on new supply. Working with your other investment divisions to see if there are ways in the fixed income portfolio or the private equity portfolio where appropriate investments could be made in affordable housing strategies. Supporting local builders and local partners by making referrals, by using your scale and your relationships to kind of push your managers to look at local markets and introduce them to local players. And generally speaking, making the connection between your real estate players and the housing agencies and housing assistance programs you have here in New Mexico, which has already happened, and we can continue to do that more, we think will be helpful to get New Mexico more on the map, if you will, to have these managers pay more attention to your state relative to other markets around the state that they invest in. And we'll stop there. The rest of our materials are supporting appendix materials, but we'll stop there and offer up some time for question and answer.
Madam Chair, if you wouldn't mind me anticipating one question, and that I think is kind of the elephant in the room, right? Why not New Mexico? And I would call out that this isn't a singular focus on managers to avoid New Mexico. There's an underlying property index, the NPI, that's somewhat broader than Odyssey, but it samples institutionally owned properties across the country. And currently there are 17 states that have essentially a 0% representation in that property index. New Mexico certainly is one of those, and it's not a club that we are particularly happy to be in, but it's a much broader problem than that. If you go to page 70 in the deck, there's an interesting table that breaks out the distribution of properties by the number of units in the structures. And one of the things that you'll find is that the concentration in New Mexico of properties with 20 or more units in them is very low relative to that comparison set of states that we generally used in this presentation. If you talk to the good people at Ventana, they would say that this data is even worse, basically, from the perspective of institutional investors if you look at properties with 100-unit rather than a 20-unit cutoff. And so a lot of our problem from the standpoint of the Odyssey type managers is we just lack scale in the kinds of property that they can execute their business plans against. And so to get their attention, that would seem to me to be a key item to consider.
Great. Thank you. Excellent analysis. I've got two questions, and I'm sure others will have. One is actually three questions. One, the supply chain. Part of what happened during COVID was the supply chain issues in the ability to get lumber and some of the supplies that are normally used in construction into the United States. With the trade wars, and with Canada, a concern about lumber and other supplies. So that's one question. Second question, I personally had my house insurance taken away by AIG when they left the state, and I know many people in the state, because of the wildfires, have had difficulty finding insurance. So I think that is particular to other states too in the Southwest, but also to New Mexico. Third question, what will happen if Fannie and Freddie Mae are privatized, and what does that do to affordable housing?
Well, on the cost side, the insurance costs went up over 60%. Homeowners insurance went up over 60% since 2022, according to the Harvard Center for Housing Studies. And it's a big challenge. The cost side is part of it. It's not just the rent, it's not just the purchase, but it's also the cost. Real estate taxes are also up double digits since COVID. So those things are affecting that affordability component that, if you're affordability challenged, if you will, that goes into that math. And that's one of the reasons why those affordability challenged indices are going up. When it comes to the trade wars, we are seeing currently, even with the trade disputes with Canada, the tariffs, we are seeing the cost side, starting to come down a little bit, or at least level off. So it seems that there was a spike in costs, in 2022 and 2021, and the worst is behind us, and it's kind of leveling off. And we haven't seen challenges on the cost side directly related to the tariffs. So it seems like the bigger supply on the materials is the costs are coming down at a greater rate than you're seeing the impact of the tariffs, if you will. So it's a net wash, and it's not really adding to the cost right now. As far as Fannie and Freddie are concerned, the privatization of those two agencies, the key is how will that work in terms of providing what they provide, which is a government guaranteed mortgage. And whether it's a publicly owned agency or a privately owned agency, as long as the government is backstopping the mortgages and providing that guarantee, which lowers the risk of those mortgages, the privatization of Fannie or Freddie shouldn't really impact that. It really comes down to how the government will structure those guarantees of the mortgages so that the bonds can be sold And that lowers the risk of those bonds, obviously, to the investors, and that creates liquidity in the market.
Okay, thank you. Other questions from the council?
Madam Chair, I have a question regarding the study. It was excellent, Malcolm, Rob, really thorough, very nicely done. Thank you for that. I just want to make sure I understand that the recent announcement by the administration that they're going to go after the institutional investors buying of, I believe it was limited, that statement to single-family homes, not the single-family built-to-rent market. What policy has followed that announcement? What are we waiting on there, if anything, or is it just another headline?
I would say it's more the latter in terms of at this point. But what the executive order, from what I've seen, what it says is it's directing federal agencies to research and investigate the issue. And the push is going to be to reduce some of these things like, the Fannie Freddie mortgage guarantees, which may not impact single-family rental as much. But what the agencies can do to segregate the entities that are receiving the benefits between the corporate ownership and the individual ownership. So trying to exclude corporate ownership from a lot of these government subsidies, and exploring that at across multiple federal housing agencies. And so at this point in time, there hasn't been any real impactful policy. It's really more of an exploratory research. What can we do? Is it legal? Will it hold up in court? That kind of analysis has been ordered. Nothing's come back yet to really impact the market, other than the headlines, which the headlines do perhaps chill the market a little bit. And right now, we don't need the market chilled. We need more liquidity in the market.
And my follow-on question is around the single-family built-to-rent sector, in that and I understand what Director Sable was saying about the collaboration with builders and so forth, but if that's being done by private equity firms, there's still a squeeze there. They can, in order to make those projects work, they control the rent that's charged in the built-to-rent single-family market, correct?
Yes, they do.
Okay.
Yeah.
Madam Chair, may I ask a question?
Absolutely.
Yes, go ahead.
Thank you. And thank you for this presentation. It was really, really informative. And I also appreciate the sort of focus on how the SIC and other institutional investors are, could potentially contribute to increasing supply. My question has to do more with how we're looking more at this first do no harm aspect of this. I as a member have been concerned, as some of the real estate investments have come before this council, that I was not fully satisfied that the projects that we were investing in were necessarily not contributing to the problem. And I appreciate the greater clarity on the percentage of investor purchases that are actually made by private equity, and that it's relatively low. But we also know that those purchases have a disproportionately negative impact on really vulnerable communities. So while they may only constitute 2% of investor purchases, they are having a greater negative impact on low-income urban communities, and Albuquerque is one of them, as I understand it. How can we, as a council, going forward, as we evaluate potential real estate investments, have more confidence that we are not, through our investment, supporting entities that are, for example, purchasing multifamily housing, rehabilitating it, so to speak, and eliminating naturally occurring affordable housing? How can we have a better handle on the impact of our investments on the housing market and be assured that we're not inadvertently contributing to the problem?
Okay. Yeah, that's a great question. And I would say a couple of things. First of all, you can tilt your investment activity in certain areas of the housing market, which is again very broad and diverse. So the three things that we identified were strategies that fund more construction, so adding units, strategies that specifically target affordable housing for low to moderate income individuals, and then strategies that focus on some of these newer, nichier sectors where they're trying to come up with lower cost of a unit to add to the housing supply. In terms of the market rate rental housing, there's an issue of obsolescence and the quality of the unit that's out there. And what often happens is your typical value add investment manager is looking for an opportunity to improve a unit or improve an apartment complex, and then accordingly raise the rent associated with that. So it's not just pushing out people or pushing rents up. It's also improving the stock and perhaps preserving the stock because there is an obsolescence factor where stock does get torn down on the supply side. So you're removing units, hundreds of thousands of units every year from the system because they're either dilapidated and torn down or they're reused for something else. So the value add component of improving stock and charging higher rent, it doesn't just hurt the renter, it also helps improve the housing stock and keep the supply up. So it's not just a single component of we're pushing rents up and pushing people out on the streets, so to speak. There's more than one aspect to it.
Yeah, and to piggyback on Rob's comment, in that extension of affordability, many times local jurisdictions will provide tax abatements in return for the developer pursuing that project subject to commitments for affordability going forward. And so there are ways that local government can support the developers in these projects. I know of several that, given the opportunity to take on these projects with appropriate support, would be more than happy to do it. But economics drive this whole big picture. The other thing that I would highlight is the market is a dynamic thing, and it's showing some amount of supply response. And I think the single family build to rent is a key component of this. It is a part of that 1% to 2% of the market that Rob had been mentioning. But if you look at these properties, they're making some trade-offs that do make them more affordable for the people who need them. There's a concentration of 3-bedroom units in a lot of these BTRs, where 3-bedroom units are tough to come by in ordinary apartment complexes. And so by making the trade-off, I'm going to take less land and maybe smaller bedrooms in a tighter community, I now can afford what feels much more like a house in a decent neighborhood for my family than I could by trying to stretch and get into an urban neighborhood somewhere. And so it's enabling people to make the decisions in their own lives that they find helpful for their own economic circumstances. And so I think that's an important part of the puzzle that we shouldn't neglect. And indeed, I think you can argue that we should probably be supporting those kinds of things. Another item that I would point to that shows a bit of a dynamic element of the market is if you go to page 69, we break out the number of units added annually by the type of units that are added. And it's kind of interesting that the single family bars are still relatively low, but the multifamily additions are basically the highest they've been since the 1980s. And so I think we're actually seeing the green shoots of increases in supply.
thank you. I appreciate that answer. But I guess what I was really looking for was not so much a defense of the policies, was more ways that we as a council can evaluate funds that come before us that have that have a real estate component. How can we evaluate are there metrics that we could look at as a council that would help us to better understand the impact of a given set of investments in residential real estate? It sounds kind of like we're not quite there yet, because we're still sort of talking broad policy, whether, building single family homes to rent is a good or a bad thing. I think, there are interesting arguments on either side of that. But again, trying to get at the impact of our investments, is there really no way that we could look at that as a council? No set of metrics that we could look at for a given fund that would help us to better understand that? It sounds like maybe there aren't.
Yeah, I think there's one thing that we can do, and we can highlight this perhaps in the due diligence on products that we bring before you. But one thing you can do, and this goes back to page 51, this concept of AMI, area median income, and what income level is the manager targeting? And again, it's going to be a blend because there will be a growing number of funds that target the low to moderate income categories, but you can ask a manager, and we have that information. What income levels are you targeting with your strategy, whether it's new build or whether it's value add, new construction? And what you'll find is that most managers are going to be targeting a whole series, a whole spread of income levels, and there will be some component of affordable, but the bulk of the strategies will be targeting kind of market rate, which would be what we would categorize as 100% of AMI or above. So you're at or above median income. That's market rate, and maybe slightly below median income would be considered market rate. So that's something we can bring back to you.
Okay, thank you. Let me
All
actually,
right.
I'm sorry, while I've got the floor, I'm sorry. I've just one more quick question about the research you did. One of the things that sort of sets one distinguishing feature of New Mexico with regard to real estate is the fact that we're a non-disclosure state, and thus the information about real estate sales and what the amount, what entities paid for real estate and who those entities were is not public information like it is in many other states. Do you think that there is a role for better disclosure of real estate transactions in helping to sort of shed light on, where a good set of real estate investments might be, at least in New Mexico?
I think a characterization of a healthy market is adequate size and significant transaction volume and transparency. And so to the extent that those kinds of disclosure would help transparency, it would probably improve liquidity in the market over some period of time. I don't think it's a panacea necessarily, but it's probably a good step. I would also, though, go back to my introductory comments for this presentation and say that there are a number of local experts who have spent a lot more time in the details of these policy type initiatives than we've been able to do in a relatively short period of time. And so I think it would be a prudent thing to engage with some of those other parties as well.
Okay, thank you.
We did have one discussion with a local operator in your state, and they specifically recited the non-disclosure as an issue because it's if you're looking at the cost of delivering a new unit, you're kind of comparing to that with what is the valuation out there in the market, and valuations are based largely on appraisals, and appraisals look at comparable sales. So if you're selling units, but you're not disclosing the price, that increases the appraisal lag. So as the prices are going up, your appraised values are lagging the market, so to speak. And then the cost to deliver a new unit looks even more expensive than that lagged appraised value. So again, as Keith said, increasing the transparency, perhaps addressing non-disclosure would help reduce that lag in the appraised values and close that gap between the cost of a new unit versus what the current values are in housing.
Thank you. Any other comments?
I have a couple questions, please. For the non-disclosure.
Okay, hold on just a second. I think the treasurer, did you?
I did.
Treasurer, go, and then I'll come back to you, Mary. Mhm.
Thank you. Thank you for the presentation. I guess I want to start off with, did we request this, or is this something to begin a conversation of some kind of shift in our asset allocation or in what we're investing on the real estate side, or what created the conversation on this end?
Madam Treasurer, at the November meeting, the governor had requested this research be conducted.
Perfect. Thank you. So I want to start off with page 14 or page 62. There was the currently 27% of NMSIC's real estate is invested in residential strategies. Do we know what percentage of that is in New Mexico?
I don't have a precise number. It's very close to zero on the basis that the properties that are being reported to NPI and Odyssey for the entire state of New Mexico are zero, as it is for 16 other states.
Thank you. So recently, we had a meeting in my office with John Clark from SIC, Izzy Hernandez, the director of Housing New Mexico, Russell Cummins from NMSSB, Small Business Investment Corp, and Marquita Russell from Mortgage Finance Authority. And the idea of bringing all of them together was that somehow we could work together to figure out some of our housing issues, also do investments that help us get some good return, and just initiate the conversation of building those relationships so that we're not working in silos. So I appreciated you bringing up Housing New Mexico because they are one of the top in the nation in what they do. They just celebrated their 50th anniversary. The question this year was, if they got more money, would they be able to deploy it? Because though they're skilled at what they do, are you able to deploy it with the amount of staff that you currently have? And the answer that they said was yes. Just to put it into perspective, they just had a press release come out this month, nearly 18,000 New Mexico families and homes impacted by $740 million provided by Housing New Mexico. Some of their funding does come from the federal government. Section 8 housing and LIHTC in particular are two programs that have some federal assistance, and there has been concern about potential attack on lowering those amounts if we didn't change policy processes. So we did work on that. For a breakdown, for those that are interested, 81 million was produced for 1,518 homes, 17 million for 739 to preserve. So one was produce, one was preserve. 582 for first mortgage and down payment assistance to 2,300 families, 58 million for housing stability to 13,000 people and families, and 739 million of total funding for affordable housing impacting the 18,000 families. The reason why I bring this up is because I really appreciate the fact that you guys brought this presentation, because there are some very critical issues that I've heard in the conversations from all of our executive directors. One, the chairwoman just brought up, which was insurance issues, especially in areas where housing has been hit with fires. The other one was the process to begin business has been difficult in some local governments. And that was something that I know Marquita Russell was looking at doing a study on to see if we can impact that portion a little bit easier. You brought up Fairfield, and I thought that was a great point, because I remember the conversation when they asked us for I don't know, 150 million to invest. And yet every state around us was highlighted of where they were going to be working except ours. And so we asked them, is there a possibility for you to do some work in New Mexico? And I think similar to what we've been doing with Pacific Fusion and with a lot of the other venture, there should be a way that we can work with our business partners and agencies within the state and with fund managers who already have this skill set and prepare them for success to be able to invest in New Mexico as we're doing business and get a win-win on the investment side. There was a question about 40 basis points better on apartments included. And so if you go to page 70, I thought it was interesting that the highest percentage was the 1 unit detached. So is that an apartment that is like on the back of a house? Is that what we're talking about?
That's your typical single family house.
No,
The units,
So that's just the single family house.
1 unit detached, units in structure, yeah.
Perfect, thank you. And Madam Chair, the mobile home was the highest of all of the states that were put into this housing characteristics of 15%. And I do know that there's a mobile home creator in Chavez County, I want to say, maybe Carlsbad area, that has been working with folks as well. And I added in the note that on a positive, because I mean, I appreciate being realistic about where we're at, but on the positive, New Mexico, when I was a county treasurer, topped the top 5 for the lowest property taxes in the country. And mobile homes are uniquely different depending on whether or not they're considered personal property or real property, depending on whether or not they're structured in the land. And I thought that was really important too, because property taxes decrease even more when it's personal property, but that's something we don't want to invest in because you can't get the ownership of it similar to real property. And then the last comment I had was, actually, that was it. So if we're planning on moving forward with changing that 27% to a portion of New Mexico investment, I would be happy to also contribute to that, being that I am on the Housing New Mexico SBIC board and the Opportunity Enterprise board. So I really think that it would be a great idea for us to use some of our funding to be able to use fund managers that we can set up for success. We get a rate of return on the investment, and we also encourage and support New Mexico in increasing housing. And the last thing I would say that I think is an elephant in the room that nobody really wants to talk about, but I'm going to bring it up. And it's not just tariffs and the increase on lumber and costs, but it's that ICE is now here in New Mexico, just like it has been in other states. And a lot of our workforce are immigrants and are very concerned about going to work or even taking their kids to school at this point. And so that also messes with our money on our portfolio when you're talking about residential property being created or construction of. And so I just wanted to make sure we note that for the record as well. Thank you, Madam Chair.
Thank you. Mary, you're up.
2 quick questions. One is the property index that doesn't include 17 states, including ours. Are those other 16 states precluded because of this non-disclosure?
No, I don't think that's a factor. I think the biggest factor is, and you have this here in New Mexico, it's really the size and depth of your markets. So, to give you an example, Utah, a border state with New Mexico, you have major market of Salt Lake City, of course, Arizona, you got Phoenix. You don't have those large markets where there's a lot of liquidity and a lot of stock to look at and a lot of trades in New Mexico. One of the folks that we spoke to about your market in particular looked at Albuquerque and if you look at the typical size of investment that the managers make in a property, it's usually 200 units and above. Well, you have 114 200 unit and above properties in Albuquerque, but that doesn't mean that they're for sale all the time. Usually only 4 to 5% are traded every year. So you're looking at maybe 4 to 5 deals come up and are available for sale every year. So it's, at a size that managers look at in terms of scale and making investments that call it institutional quality, if you will. So you just don't have that depth of a market here in New Mexico. And that's a factor across all the smaller states that don't have the big metro markets. So Oklahoma, even you throw in some Vermont and Maine, across the country, the Dakotas, you have these markets where there just isn't that large, deep market that institutional managers like to invest in because they want to be sure that there's an exit when they complete their business plan on the property.
My second is a comment that you can see that we're struggling, or at least discussing what SIO John Clark would say, what is beyond our doors here? We're here to manage the corpus of the SIC portfolio. In doing that, I look at what the SIC professionals do to get us to a point with our consultants to come up with best-in-class managers for the portfolio. So it's to Member O'Donnell's point, it's a constant, do we want best-in-class, steady, great managers in the portfolio? Are we trying to also help New Mexico? And it's a very fine line where that shows up.
Madam Chair and Member Roman, just to add to that, so some of the funds in the severance tax permanent fund are being used for this purpose by the Small Business Investment Corporation. They get 2% of the ending value of the fund, and they have legal authorization to provide essentially their version of economically targeted investments. And they've been exploring ways that they can help promote more affordable housing through low interest rate loans. And so they're able to do that through that fund. We don't have the legal authority to go after below market rate investments. The legislature has not given us that authority. But I think it is important to note that some of the funds that we manage are going to be used for that exact purpose by the Small Business Investment Corporation, who has that as part of their purpose.
Any other questions?
Madam Chair,
Go ahead.
Chair, this is Kurt Summer. First of all, this is an excellent report. Thank you for the effort that went into this. Is phenomenal. Looking at page 59, it looks to me like unless we got into the fourth option there, we really don't have an opportunity to target New Mexico, given the type and given what Mr. Clark just stated. In terms of investment for helping affordable housing is what it sounds like.
The number of opportunities to make commitments to particular funds with an existing footprint in New Mexico is nil to very small. I would call out that we're trying to identify high quality, best of breed managers where we may be able to work out collaborations over time that rely on our scale and the depth of the relationships. I had called out Fairfield. Certainly when they made their presentation to council, they did put up a map that showed that they were active in some of the neighboring states and not New Mexico. That was a mistake from a presentation perspective, certainly. But that would be the same map that virtually any other manager would have to show by virtue of where their assets are. To Fairfield's credit, they have engaged with a number of organizations here in the state, and they've been in close contact with me both in terms of preparing this presentation, but also in terms of proposing ways that we may be able to work together outside of the existing fund strategy. So they do have an affordable fund or affordable housing fund in their line of products. And that was operations related to that fund that caused them to engage more deeply in New Mexico. Like many other managers, the initial conversations were around the idea of there's certain parts of the economic puzzle here that create holes in the capital stack. And equity owners tend to want to fill those gaps in their capital structure with the least expensive possible financing. And so that goes back to subsidized financing angles. And so, we're continuing our conversations. The ones that I've had with them are not particularly unique in terms of what would help them engage more actively, more speedily. But they are illustrative of the kinds of folks that we're trying to do business with and the kinds of activities that we're pursuing in the interest of the state.
Madam Chair.
I have one other question if I could. I'm sorry. Madam Chair, and I'm wondering whether you did, as part of this study, look to see what programs New Mexico offers for affordable housing and to encourage affordable housing. And is there a lack of funding in those various programs that require more money? And if there are, is there some way within our existing legal structure to invest in those funds?
Our primary focus was developing a data-driven understanding of the problem more broadly. And the part of this problem that we touch most closely is allocating funds to fund managers with whom we can partner to address the issues. There are a number of other organizations that have been mentioned throughout this conversation today that I think are closer to the issues that you're inquiring about. But I think having a broad conversation amongst those parties probably makes a lot of sense.
Thank you, Madam Chair.
Madam Chair.
Go ahead.
I greatly appreciate where Member Summers' head is going, because there was a comment made earlier, well, are we doing this or are we doing this? And I think as New Mexicans, for some reason, we have a tendency to think it's either A or B. It's always right or left. Can we make money, or are we helping save somebody with a house over their head? I think you could do both. I think the same way that we have private equity and we have studios who help make them be successful, we have Housing New Mexico that can play out like a studio, that we can invest in a fund that already has the skill set, and then we educate them about New Mexico. We help them lean in, and we help make money at the same time of housing our own people here in our state. So I think we need to start looking at it as how can we use our 58 whatever billion dollars, second largest in the country, to start investing in our own communities and strengthening our own communities, which only strengthens our portfolio. Thank you.
Okay, Member Sanchez.
Yeah, I just thinking about this and working on housing in New Mexico for many years. I think there's two pieces to this. With the creation of this body into return on investment for the people, there's two parts. One is an investment that is returning, and I think what we're really starting to talk about is a beneficiary issue to housing for low income. I think our investment, we're committed to multiply and grow the trust, and that won't happen in a low income loan. Therefore, I think that would have to return to the legislature if they wanted to earmark or create a new trust. Looking at the future with our growth, the last time we talked about growth here was that there would be close to 120 billion by 2032. So we should keep this on the radar, but that's for the legislature to discuss if they want to create a new beneficiary like they did with the Early Childhood Trust Fund, which has grown and been something amazing. I think that's where our role would come in, is managing the money for a beneficiary of housing or be it healthcare, what other issues that the state's facing. So this is the dilemma that we're in. We're here to grow this, and then the growth of it could benefit, I think, where it's not an investment directly from our portfolio, because that would go against the policies that we have in place today.
Madam Chair.
Yes.
Just to be clear where I'm coming from, I definitely don't want to do, and I don't want to freak staff out if that's what it came across as, what Member Sanchez was just mentioning. What I'm referring to more is when we're investing in fund managers similar to Fairfield and whoever else in real estate that we're considering, that we're also considering or factoring in the potential or opportunity for them to work in New Mexico. And we would use that opportunity to have them tie in and work with Housing New Mexico or with their counties and cities that they're wanting to work in, so that we can make it an easier process for them as it relates to them doing the work on the ground. So I don't want SIC team to think, oh my God, we're already stretched thin and she wants us to also be in charge of housing. No, I don't. It's that would the fund managers that would come before us and who you guys are vetting can have these types of skill sets and opportunities for us when it applies, that we utilize it. Thank you. Sorry for any miscommunication if it came across anything different.
No problem. Great discussion. Any other comments or questions from the council? Well, thank you, gentlemen, very much. Really an excellent research, a really important topic to us, and you've given us lots of things to think about in terms of considering investments in the future and how we work that. So thank you very much. Appreciate it.
Thank you all. Thanks.
All right. Next, we have up an investment policy statement, some technical updates in staff member Iglesias and RVK.
Thank you, Madam Chair and committee members. Good morning. I'm just going to give a brief introduction and then turn it over to RVK to discuss the details. So this investment policy statement revision is technical edits that we try to bring to you each year, either at the very end of the year or at the very beginning of the following year, in order to capture anything that has occurred that the council has already approved over the course of the prior year, and making sure that those are sufficiently incorporated into the investment policy statement. We have been trying to incorporate a lot of those changes as we go, and we'll continue to do that, but inevitably there's always some cleanup that's needed at the very end or beginning of the next year. And so that is what's captured here. It reflects any changes you have already approved in either structure studies or legislative changes that have come through in order to add language for new funds, and any other additional small cleanup just to make sure that the document is up to date and consistent and readable. To that end, there is a significant amount of redlining on pages 15 and 16 of this document. That would be pages 91 and 92 of your diligent book. And just to note that that is, again, a cleanup. It's consolidating a table on page 14 and taking all of these individual tables on pages 15 and 16 and making them into one clearer, readable table. So any actual changes that have been made or incorporated into that is included in the red line portion of the table on page 14. However, I do want to draw your attention to one edit that the treasurer brought to our attention, and we want to make sure that you're fully aware. Is on the table on page 14, you'll notice that the 3% under the economically targeted investments is separated out and redlined. That is appropriate, as was approved in the structure study that was approved last year for the New Mexico Strategic Venture Capital Program. However, the words economically targeted investments showing that this has been added to that line should have also been redlined, and we apologize for missing that. It is appropriately redlined on page 12 and the table that's there, but we missed it on the one on page 14, so I just did want to note that for you. I'm going to go ahead and turn it over now to Marcia and Matthias to discuss their cover memo and then open it up for any questions for the committee members.
Thank you, Dawn. Madam Chair, there is a memo on page 75 explaining each of the changes. As Dawn said, these are changes that you've already approved. They're just being put in policy. Some of those changes are general, and you'll see them throughout, and some are specific. So we'll tackle the general technical updates first. First of all, page numbers. There's page numbers. Second, and I also want to say as we go through this quickly, you'll notice how busy you were last year. Structure studies, asset allocation work. So we just want to make sure that's all in your investment policy. First, as far as real assets, you did a structure study. At that time, real return, you did that study in March 2025. In that study, it wasn't referenced as real return, it's real assets. We think that's appropriate, and we've changed that generally throughout the policy. So that change, you'll see a red line Under asset allocation, you'll see it under the matrix of rebalancing, and you'll see it under benchmarks, plus under guidelines. The other change in naming was really a change a bit in philosophy. You did a private equity structure study last year as well in April. At that point, you had an in-state private equity portfolio. A big change was made, and it was decided to have the Strategic Venture Capital Program. So the Strategic Capital Program, again, is shown changed throughout this document in the same places: asset allocation, rebalancing, and benchmark. So that change is throughout. You also gained the responsibility for 2 new funds last year, the Behavioral Health Trust and Medicaid Trust. And that was and the allocations were approved in June of 2025. So those are shown a couple places, or more than 3 places in this policy. They're in the authority section, section 1. They're in the section 2, the statement of purpose, and then again, they're in asset allocation, the rebalancing matrix, and under benchmarks. Then in May of 2025, you made a change to the asset allocation of the severance tax program. And this refers to what Don was talking about. At that point, it was decided that the Strategic Venture Capital program should have a dedicated 9% return or allocation, and also that the economically targeted should have a stated 3% allocation. The 3% came from a decrease in real assets, private fixed income, and real estate. That's acknowledged throughout this document. And under asset allocation, again, the matrix and the benchmark. So,
And Marcia, just to clarify for the committee members, that 3% economically targeted investments is required by the legislature. And so this is just noting that required 3% allocation, as was noted in the structure study before. But I do want to point that out, that that 3% allocation is not one that we have the ability to change, because it's directed as a shall make those investments. It's the Small Business Investment Corporation and the Small Business Recovery Loans that were right after COVID. So just clarifying on that.
it had been lumped in with the New Mexico private equity. So now, since you've done the Strategic Venture Capital Program, it was appropriate to separate that out. So next, specific technical updates. I think it was Member Roman that pointed out some of the funds did not reflect a date of establishment. So we went through under, pardon? Oh, I'm sorry. So under section 3, or section 2, I should say, we went through and made sure that for each of the fund, there was a date of establishment and some additional details on each of the funds that we could find. So those were added to the policy under statement of purpose. So you'll see some red line additions there, just clarifications and additional information. And that affected the land grant, the severance tax, tobacco, and opioid. You'll see additions there. As Don pointed out, under section 8, the rebalancing is now a matrix similar to the asset allocation matrix and the benchmark matrix. So we did the target ranges as a matrix, and therefore all that redlined under pages 15 and 16. There was also a change to a footnote, and this was clarification that Don discovered that needed to be made regarding the land grant. It was updated and expanded to also reflect the tobacco settlement and conservation legacy permanent fund. So this was updated language that we included in that footnote. And then in regard to performance benchmarks, as part of the March 2025 real asset structure study, there was a benchmark change to CPI plus 4%. That's reflected in the benchmark matrix. And then, as we mentioned before, the economically targeted investment benchmark was added for the severance tax fund based on your approval in May, and that was added to the benchmark matrix as well. And we're happy to go through this page by page, but that is a summary of all those decisions that you made that are now in policy.
Great. Any questions or comments from the council? Treasurer Montoya.
Thank you, Madam Chair. I just wanted to thank the team for recording the CIC meeting because it was, I think, the same day as opening session, and thank Dawn for the response to all of my questions. So I have no questions today, but I think this is great that you guys cleaned it up, and I really appreciate the graph being all on one page. It makes it easier to be clear on where we're at when we're looking at decision making. So thank you all.
Any other comments?
Madam Chair, just, I want to make sure I'm clear on something. These 2% of the severance tax fund that SIO Clark had mentioned, that's something that was established a long time ago. It sounded like around what we discussed, the investment committee meeting was around 2000, that time frame. And that 3% economically targeted investments is a target. Is that 2% happening and now we're trying to get to 3, or are those two different things?
Madam Chair, Member Roman, those are two different things.
Okay.
We don't include, or let me turn it over to Ms. Iglesias for additional clarification.
Member Roman and Madam Chair, so the 3% is the total. It includes the 2% allocation to the Small Business Investment Corporation, plus an additional roughly 1%, which is what is allocated to the COVID small business recovery loans that were passed in 2020.
Thank you.
All right. Any other comments or question? Is this something, Brent, that we should do a roll call vote, or can we do an ayes vote? Pardon? Okay. All right. If you would take a vote then, please. Roll call.
We need a motion.
Actually, let me make a motion then. Hold on one
right.
second.
Go ahead.
Let me get you to that point. Unless someone else has it faster.
I've got it. All right. Member Sanchez is going to do it. You can second. How's that?
Perfect. That's great. I just wanted to make sure we took care of you before a vote.
Based on the recommendations of the Council Investment Committee, Advisor RVK, and the SIC staff, I move that the State Investment Council approve update to the investment policy statement as memorialized, reviewed, and discussed by the council today.
Do we have
I'll
a
second the motion.
Thank you, Treasurer. All right. I think we'll take a roll call vote now.
Treasurer Lori M. Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Teas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
Mary Roman.
Yes.
That's 9 in the affirmative. Motion passes.
Thank you very much. All right. And thank you very much for the updates for RVK and also for you, Ms. Iglesias. All right. Next topic is the SVCP at One Ventures 3 LP re-up for 30 million. Chris Cassidy, Bruce Brown, and Mercer.
There we go. Thank you. So this month we're recommending a 30 million commitment to At One Ventures 3. This is an existing relationship. At One is an early stage deep tech climate fund. If you recall, in September 2023, At One was the first relationship in what we call our climate tech sub strategy. We have several managers in the portfolio that have it as their core mission to help decarbonize the economy, basically. We have, given this is largely a deep tech portfolio, frankly, a lot of our managers invest in technologies that ultimately would make the economy more efficient and decarbonize. That being said, that several of them, including groups like @ONE and Lower Carbon, that's part of their underlying mission. They've been a great partner so far. They're probably, and I say this as a compliment, probably one of the most technical groups in our entire portfolio. They really, when you think about the climate crisis, it's really a physical problem of stuff ultimately being built. And they really think hard as early stage investors is how do they get a company from not only taking the science and actually ultimately manufacturing products which will decarbonize the economy. They have several companies in their portfolio that are exploring expansion into New Mexico. Somewhat timely, one of those is actually looking to address the housing crisis in the country. We couldn't have planned this, by the way, but two companies in the portfolio. One's a company in the @ONE portfolio. The other's a company in the Antler portfolio. I think there's several founders that realize we obviously have a national housing shortage, and how do you generally address the housing shortage? It's by figuring out how to produce houses at lower costs. And so two of these companies are going to be building in New Mexico in the foreseeable future. I don't want to steal anybody's thunder because they plan on announcing those separately. It's in the materials, the two companies that we talk about. I'm going to pass it along to Bruce before we pass it on to Mercer to talk about, given he's our new head of strategic climate initiatives, have some thoughts on climate generally. But I also wanted to introduce Keith Flynn to talk about the Ventana Fund, which is where he came from, which is the SBIC-backed fund that we talked about earlier, or Keith Sable talked about.
So just briefly on the climate, this is our first climate tech fund back in 2023. So it's a very exciting thing. I think a couple points I'd like to make. First of all, people think about climate in terms of energy, the energy transition. That's a big part of it. That's what's going on. This particular fund, I think it's about a quarter of their investments are energy related. The rest are sort of carbon related. And one of the more interesting investments they've made is in cattle feed, which is, as you may know, cattle release a lot of methane as part of the process. They're working with a company in Australia that has figured out a way to reduce the methane sort of release from eating. The result is less methane, but more importantly, it's also making the feed more efficient. So methane, just chemically, is carbon and hydrogen. Cows' meat is carbon, hydrogen, oxygen, and nitrogen. So if you're releasing less of the carbon and hydrogen, instead you're incorporating that into the cattle, it's a more efficient feed, and that's what's going to make this feed take off. Not the fact that farmers are particularly interested in reducing their carbon footprint, although some are. It's really an efficiency thing, and it's going to result in a much more efficient cattle feed that they've discovered. And it's just sort of, so that's sort of the big sort of mandate of what @ONE is doing. They're also in the housing company that's more efficient, which we may or may not talk about. But it really has to do with efficiency. If you think about you're exuding carbon, you're not using everything you could. It's less efficient than it might otherwise be. So it's a nice net effect that it reduces the carbon footprint, but really it's about unit economics and making things more efficient. And that's why these guys are very good for us. Another point, in the memo, we note that investing in climate tech hit a high in 2021. I think I'd like to provide some context on that. This is the VC environment, not climate investing generally. Depending on how you count it, it's grown substantially since that time. So it's like the International Renewable Energy Agency, of which the United States is a member, estimates that in 2020, there's like $1.4 trillion, $1.2 trillion invested in the energy transaction worldwide. So in that year, $1.2 trillion was invested in this. Their last year figures was 2024. And in that year, the investments were worldwide were totaling 2.4 trillion. So doubling in 4 years. So climate tech, loosely, depending on how you define that, is growing exponentially. And we hope to take advantage of that. Obviously, the fact that fewer people are investing in it or that the VC is down is a blip, and it does affect what we do. But the trends worldwide are pretty clear. And investing with the best, we'll be able to take advantage of that. And certainly from our experience, we think that @ONE is one of the best.
Keith, do you just want to make a couple comments on the Ventana Fund and what it does for on the affordable housing side and what it doesn't, frankly, as well?
Absolutely. Good morning. My name's Keith Flynn. I'm the new private equity analyst, new-ish, started in May. Before that, I worked at Ventana Fund, and Ventana Fund is a nonprofit CDFI that finances the acquisition and rehabilitation or new construction of affordable multifamily housing across the state of New Mexico. It's wholly focused just in New Mexico, and they primarily focus on 5 to 50 unit multifamily projects throughout the state. They don't do single family. HomeWise is a CDFI that focuses on single family lending, but Ventana Fund focuses on the multifamily side.
So welcome to the staff.
Good morning. Thank you. Thank you, Madam Chair. I'm going to focus on the fund, @ONE Ventures 3. @ONE Ventures is currently led by 3 partners, Tom Chi, Lori Minood, and Helen Lin. Tom Chi founded the firm in 2020 to focus on early stage venture capital technology investments with the goal to find companies that can be more efficient than incumbent technologies, but also deliver positive environmental impacts. And he has over 20 years of experience in leadership roles at Google X, where he's one of the founding members, and Yahoo. He was also an executive in residence at Crosslink Capital. The team's been stable, and the firm really differentiates itself with its operational and scientific expertise. The partners do have a number of board seats, that came out from our analysis, but they do plan to transition some of those to the principals and vice presidents. We really saw the team build out since the last time we brought them in front of the SIC and the last time we did deep due diligence. And this is something we'll continue to watch in the future. The strategy focuses on deep tech companies in sectors like energy, agriculture, manufacturing, food, transportation, construction and building, and ecosystem restoration. The firm plans to primarily lead, seed, or Series A investments. So these are very early stage companies with total investment in a company averaging 10 million to 12 million. But they really have a hands-on approach with companies, which is a differentiator in talking to others in the venture capital industry and a lot of the portfolio company CEOs. They particularly help companies with scientific guidance, follow-on financings, and talent recruitment. And they really have a global focus and a network, which is impressive for a firm of their size, and really focus on opportunities in multiple geographies. The fund size is also staying consistent compared to the prior fund. When you look at performance, it's still early at the firm, given that deep tech investments usually take a while to emerge. Fund 1 has generated top quartile performance to date. There's one company that's really driving that performance, but they do have multiple companies in that portfolio that are valued above a 2x return. Fund 2 is still relatively young, with the average hold period on those investments being 1.6 years. And I think, when you step back and look at @ONE Ventures 3 with the new strategic venture capital program that we talked about last year, I mean, this fund really encompasses the 3 objectives that we discussed in that structure study. The first being a deliberate sector focus on those sectors where New Mexico has a right to win. They're focused on areas like deep tech and climate tech, where New Mexico does have a competitive advantage. They're involved in company creation engines. They're part of the Roadrunner Venture Consortium. And with their pre-seed and seed focus, they are focused on really kind of building up more early stage companies. And then finally, support for scaling of operations in New Mexico. And I think this part has really opened up the opportunities with @ONE Ventures. They have one company right now that's looking to expand in New Mexico, and then they have a number that's in the presentation that they provided a number of different opportunities that they're looking for expansion into New Mexico. So we're recommending an up to $30 million commitment to @ONE Ventures 3. Chris, do you want to say anything else? Or all right, let's pass it to Sarah Rubin from @ONE Ventures.
Thank you, everybody. Thank you for having me. It's great to be here. @ONE Ventures is an early stage venture firm that seeks to find, fund, and grow companies using disruptive deep technology to upend the unit economics of established industries while dramatically reducing their planetary footprint. Our mission is to help humanity become net positive to nature, and we pursue that mission by backing companies whose technologies can scale economically in the real world. We believe climate progress only endures if solutions work at commercial scale. So financial success isn't the goal on its own. It's what allows these solutions to persist, scale, and actually matter. We are led by a partner group that aims to combine deep technical judgment, industrial execution, and institutional investing discipline. Our partners have played significant roles in building and scaling globally impactful projects, including work at Google X, Microsoft, SRI International, Bard Capital Partners, and more. That experience allows us to rigorously assess and stay deeply involved as companies move from lab to pilot to full commercial deployment. We diligence and invest in some of what we believe to be the most advanced climate and industrial technologies in the world. And just as importantly, we help founders make informed decisions about how those technologies should scale. Many of our companies face complex manufacturing and infrastructure decisions, and we work close with our founders to determine the locations that best support long-term operational and economic success. Beyond the partners, our primary differentiator is our ability to engage deeply on technology and scale up. Our team has real experience not just evaluating complex technologies, but understanding what it takes to commercialize and industrialize them, how they behave at scale, where they can break, and what is required to turn them into reliable, cost-competitive operations, drawing on experience scaling technologies inside organizations such as Tesla, Apple, and leading industrial engineering firms. More than half our team is dedicated to hands-on operational support, working directly with founders on manufacturing scale-up, supply chains, IP strategy, hiring, and execution through early commercial deployment, the stages that are most critical to building durable, scalable companies. All of that is the context for why New Mexico is a compelling execution partner for our platform. We work closely with our companies on manufacturing and deployment decisions, and New Mexico's strengths, from industrial sites and workforce to resource availability and close collaboration with government and regulators, align well with the needs of many of the capital-intensive technologies we support. So I'm actually a native New Mexican. I grew up here and still spend significant amount of time here. Hope to move back full-time at some point, and this work has been especially meaningful to me. I have a deep appreciation for the state's strengths, and I'm proud that our team and our portfolio companies share a genuine enthusiasm for building jobs, factories, and businesses in New Mexico. New Mexico has made clear that it wants to lead in climate and be a green state, and that ambition aligns closely with our mission. We've really valued the collaborative nature of the partnership. Chris and Bruce in particular have been great to work with as we work through how to successfully attract and support our companies in New Mexico. We've been engaged with New Mexico for several years with an ongoing working relationship that is naturally deepened as opportunities for deployment and execution have emerged. That engagement is already producing concrete results. We've supported one portfolio company in fully committing to New Mexico in the advanced housing space. That project is expected to begin operations in 2026 in partnership with a local New Mexico developer, and is expected to support 300+ jobs, deliver 300+ homes per year, and create the potential for multiple additional factories across the state over time. More broadly, across our portfolio, 7 companies currently have a real active possibility of establishing operations in New Mexico. The current pipeline of companies actively evaluating the state represents more than $1 billion in potential project deployment over time, based on estimated capital required for pilots, manufacturing facilities, and initial commercial infrastructure, reflecting the scale of project these companies could attract as they grow. As time goes on, we expect the pipeline of opportunities will continue to expand as our companies grow and as we invest in new companies. We've also been intentional about embedding ourselves in the New Mexico ecosystem, Through the Roadrunner Consortium, engagement with Los Alamos and Sandia National Labs, and hands-on New Mexico-focused diligence, we look forward to deepening and expanding our impact in the New Mexico ecosystem. We see New Mexico as a place where leading climate technology and real-world execution come together, and we're excited to continue our partnership with the state to build lasting environmental and economic value. Thank you for the time and for the opportunity to speak today.
Thank you. Member Sanchez, I think you had a question.
Yes. Well, first, I want to congratulate you. I'm very happy to see this come forward. My question is to the staff. Is there a zero missing? Is there a typo on this? Because it got 30 million on there. I don't know if we dropped a zero or if we have a typo on there. Because that's how enthusiastic I am about what you're doing, and that we're going to watch you real closely and hope that we can continue the partnership and you come back so that we can partner together, because it's going to have a great return for the state, but not just here in our funds and what we're counting, but maybe throughout the whole world. So congratulations.
Thank you.
All right. Other comments or questions from the council?
Madam Chair.
Yes, Treasurer.
Thank you. I'm sorry, I didn't catch your name or title.
Yeah, Sarah Rubin, Chief of Staff at One Ventures.
Thank you for the presentation to all of you. So a couple of thoughts. I'm with Member Sanchez on this. I could put hearts all day on my screen just because all of this ties into what Chris and Bruce were saying, not only on the data and the opportunities in this type of investing, but that it ties into New Mexico. We're utilizing our own resources and we're benefiting it twofold on rate of return and also on community impact. So the only question I have is, and I believe Mercer brought it up, but on page 124, or he mentioned the 35 portfolio company boards. I'm on 13 and I struggle a lot of times, and I know you guys are resolving it, but I do want to note that as a council member, I do have some concern. I know there's some benefits to it in tying people together and knowing what's going on out there, but 35 is pretty significant. So I'm grateful that you guys are working on that. And the other thing that I appreciated, sounds like Fund 2 is doing really well. I appreciated what I see on page 131, which I'll just leave it at that on the second paragraph, as far as what we're working on the shift from Fund 2 to Fund 3 as it relates to costs. So thank you very much for what you're doing. For the council, some folks just reached out to me this last week asking what we're doing on ESG or on climate. It's not in my wheelhouse, but seeing something like this and seeing that this is the second time we invest in it, I think is something everyone in New Mexico will be very happy and proud to hear about. So I'm hoping, even though it's only 30 million, because it is a small emerging diverse manager, I'm hoping that staff will put out a press release about this, because I think this is something that New Mexicans need to know that all of you are doing. It's a hard, skilled type of expertise that we need in our venture team, which they have, and I think that's something that we are very proud of and should put out there. So thank you.
Any other comments or questions? So thank you for the presentation. Excellent. And I agree with the treasurer, having something that's investing in New Mexico, but in particular investing in climate, reducing methane gases, and all the things that will help us to have better agriculture as well as a better climate. So thank you. So I think we'll go, I need a motion to vote. Member Sanchez?
Madam Chair, based on the recommendations of the Council Investment Committee, Advisor Mercer, SIC staff, and general fiduciary oversight from RVK, I move that the State Investment Council approve a commitment of up to 30 million to @One Ventures 3 LP, subject to the contingent upon New Mexico legal requirements, New Mexico State Investment Council policies, negotiation of final terms and conditions, and completion of appropriate paperwork.
Madam Chair,
Yes.
I second the motion.
Thank you, Treasurer Montoya. We have a motion and second. We'll go to roll call vote.
Treasurer Laura M. Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Tejas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
Mary Roman.
Yes.
That's none in the affirmative. Motion passes.
Thank you very much. Thank you for your presentation. All right, we now will move to the financial matters, the CFO report. Staff member Brent Ship.
Thank you, Madam Chair. Thank you, Madam Chair. I'll be as quick as I can. If I could have page 209 brought up on the screen. I just wanted to, I think this is the first, can you scroll to the bottom of that? I think this is the first month that I've presented a investment holdings report. We've broke through $70 billion. Very proud of that. I think when I started here in 2012, I think it was April, May, we were at $15.5 billion. So this is something really to be proud of. You will note in this investment holdings report, it's fairly lengthy. I'll point out again, as I do most quarter ends, this is a quarter end. It's a December report. It has 14 funds. It has all of our clients listed. You not only have fund snapshots, you also have roll forwards from the prior month and the prior quarter. You also have a notes page. And I don't have really anything in particular, but if you look at this report and go home and have any questions, please feel free to drop me a note, and I'm happy to answer any questions that you might have. And I've also included the budget schedule to date. As John pointed out, I think we've had some and continue to have good success at the legislature. One of the things he didn't touch upon, and I'll touch upon for fiscal year 26, the fiscal year that we're in, we are seeking additional bar authority. We just don't have enough budget right now in our current budget to get us through the end of the year. I'm anticipating probably asking for a budget adjustment request to get us through the end of the fiscal year of about $20 million. So that'll be something that we do going forward. And then starting on page 301, and I'm not going to go into detail, but I have included the audit report for fiscal year 25. It's a unmodified report, no findings, no audit adjustments other than the lagged valuation adjustments that we provide our auditors. No findings at all, and I'm really proud of that. I want to give special thanks to Two Riggs, who is our accounting director, and also thanks to our accounting coordinator, Norma Parra, analyst Steve Benioff, and Amy Pompeo. And I have an administrative accountant that works very closely with me, Rita Sheet. She handles invoices, POs, just about anything I can ask her to do. She does. She helps with several audit schedules, including fixed assets. I want her to know how much I appreciate it. And then John didn't mention this, but I will. I hope it's okay. I want to welcome Emily Oster as our new CPA analyst. Emily comes to us with the experience from DFA, the state auditor, TRD, and most recently, she was the finance director at the city of Santa Fe. I think she's going to be a great addition to the accounting department. We are looking for additional CPA analysts. One of the things I especially like about Emily is she comes with over 10 years of experience. dealing with auditors, and that's something that we really need. So I want to welcome her, and I think there's great things to come at the SIC, and that's all I have, unless there's questions.
So,
Madam Chair, if I may just add, I really want to extend my congratulations and thanks to our incredible accounting team. They put in unbelievable amounts of work during the audit, but also around the year. So really huge thanks to them for another job well done.
so I was just going to say the same thing. Thank you, in particular, Staff Member Schimpf. Your leadership, your humbleness, your attention to detail is amazing. And all the audits that, since I've been a member, have been fabulous. And just, you give us great confidence that you're managing the money, you're managing the budgets, and giving us the right kind of information. So thank you very, very much for doing that. Really appreciate it.
Thank you.
And I know
Madam Chair?
Yes.
I definitely have a lot to say. And I'm so grateful that you mentioned the gratitude of yourself on behalf of the council, because no one pays attention to the finance group until there's problems. And so I like to pay attention to Bruce. And thank you, Charles, for nodding on that one, because it's true. No one cares about them until stuff hits the fan. And SIC has been kept with the amount of growth and the complexity of what they do on hand with Bruce's leadership and with their team. We work a lot with too, and we're very grateful for her leadership as well. We transfer over billions of dollars throughout the year, and we work together pretty significantly, and it's a good team with DFA. And so I just want to say great job to you and your team. This is amazing to not have any audit findings on that amount of money, and to tell us that we're already at 70 billion is pretty phenomenal. You guys clearly remind me all the time that it takes money to make money, and for you to be able to go with the speed that SIC's direction is going has been really just amazing. So great job to you. Kudos. And thank you for all the work you and your team do to help us to be so successful.
Thank you.
And you're getting new employees, so that we know you need staff. So that is a good thing too.
That is absolutely the case. And I will tell you, with 14 funds that we have right now, we're finding new challenges that we didn't know we were going to have. For instance, for the Higher Education Trust Fund, after we put out the initial draft of our audit report this year, we were told that we needed to make an adjustment because there is a reversion coming from the program funds back to this fund, but no one had told us. So we're getting our feet on the ground on these new funds. There's some learning that takes place, but I think if anything, this past year end has told me is we absolutely need additional people, and we need to be proactive and continue to talk and train and get better. And I think if we do, we'll be successful.
Great.
Madam Chair,
Yes.
one last comment. Emily, if you all don't know her, I mean, her record speaks for itself, but she is a phenomenal rock star. I've tried to work with her and still her several times, so that's wonderful that SIC was able to get her on the team. She's a team player, and she knows it from the internal aspects to the audit aspects, and those are two different brains in a financial world. So I think that's great that she's an add-on to your team.
If I may, Madam Chair.
Yes.
Yeah, I want to just reinforce everything that's been said. Working with Brent on the audit committee has been really educational, and I've grown to have a lot of confidence with Brent's work and the team's work. And we can't emphasize enough how much complexity has happened in a short period of time. I mean, when I first, started with the SIC, as you've heard me mention before, we were at $24 billion. Now, we're at over 70 billion. They manage a lot of funds on behalf of many different entities in New Mexico, local governments, universities, And I mean, that's just to name a couple of the many that they work with. And working with those investments have really helped the local communities. Brent's responsible for all of that. And so um, just want to just share my gratitude to his work and his team's work because they really are performing at a high level to have no findings in a situation where we do have a new auditor. We just started this year's audit with Baker Tilly. A lot of the time, when you start with a new auditor, they find things that, hadn't been found before. So it's just exceptional work. And then also the agreed upon procedures always come back with the highest of marks. So yeah, just wanted to share that. Thank you all so much.
Thank you. Any other comments? So you can see that we really appreciate you very much and appreciate your team and hope we're going to get more people for you. So especially with the complexity of what we do.
Thank you, Madam Chair.
Okay. All right. Next, we're going to talk about the government, our committee report. The governance committee met January 8th. We had an update on the CIO search. We spent quite a bit of time talking about the proxy voting update and had professionals to give us more of a viewpoint of what's going on with other institutional investors in this area. We talked about the SIO evaluation process, and again, that'll be part of later this morning's topic. And then we had an update on the tactical projects that Ascension has put together for us. So we have a regular update of where we are against the projects that we specified. Some of those we're waiting for the new CIO to finish. So we had a robust talk. We are meeting again in March to continue the conversation about the proxy voting. I think we've all agreed that we're going to come up with something in writing that's a guidance for us, for the council around this issue and understand sort of the pros and cons of what we may or may not do and when we might do it. So that was the governance report, committee report. I may or may not be rolling off my term has ended for the council. And if I don't roll off, I'll stay as chair. If I do roll off, Kirk Summer has agreed that he would chair the governance committee. So we need a vote today to have him become the new governance chair when I roll off. So Member Sanchez, if you would do the motion.
Madam Chair,
Yes.
being that we don't know if you are going to roll off, I'd rather wait until we know because I don't have any inclination that you would not continue to work with the council.
The problem is the next meeting, I think I would, if I roll off, I wouldn't be at the next meeting. That's the reason we wanted to kind of do this ahead of time so that we have continuity.
And Madam Chair, also, yeah, just to clarify that the language of the motion is contingent so that if you stay on the council, the language of the motion would keep you as chair until such time that you do roll off.
Madam Chair, it's a committee, so we can still run a committee without a chair if we needed to, or somebody can take the lead. But has all of the council known that we're considering doing this, or do we know if there's any people that are interested in it? You have two statewide electeds that are not here today because everyone's caught up at the legislature. So I'd feel more comfortable just waiting, and when we have our meeting, I think you get to stay on the council until the actual governor appoints somebody new if she were to decide to appoint someone new. Isn't that correct?
I'm a legislative appointee, so that it would come from the legislature. Mm-hmm.
Sorry.
That's the reason there's a time issue about it.
Yeah, I have a comment.
But one moment,
Go
just
ahead.
because I have the floor. But isn't it correct that until the legislature or whoever's appointee gets appointed, that that person stays on the council until that point. Every other board I'm on is that way, but by statute, but I didn't know if this one was.
It is. If they appoint someone, then I'm off right away. If they don't appoint someone, from what I understand, I have another year until the next legislature, but I'm a legislative appointee. So I'm one of their people. And I think that, well, I don't know if they have someone in mind or not. We don't have anything definitive yet about that.
And so, Madam Chair, I would propose that we ask them if they have someone in mind. But until then, I've noticed that we never put somebody in that place for a really long time. So you would still be on the council until that point, and there's only a 30-day session with 2.5 weeks left. So I think we should wait until everybody's here and not in session to make a decision like that, because we don't know who all has interest in being able to do it, and it's sort of jumping the gun. That's all I have.
Madam Chair.
Yes,
To
Nick.
follow up.
Yeah.
To follow up on that, yeah, I noticed that on our agenda, we also have appointing of some members to the investment committee and the governance committee. And again, this does sound like we're jumping the gun because we're about to appoint somebody to the committee that hasn't had a chance to review what has been discussed in the committee in terms of the chair. So I too would like to just take some time on this.
Well, so the appointment of a person to the investment committee is just to make it, that person can serve until the end of the legislature. If that person is, which we think will be approved by the Senate, then they become a permanent member of the council. So we're looking at just making sure that the council has appointed that person to the investment committee, not as chair, just as a member of the committee.
No. I'm talking about, I think that I read that Kelly O'Donnell's being appointed to the governance council committee.
She's asked to be part of it. John, can you help me out on that? How do we handle that?
Madam Chair, the committees don't exist in statute, so however you as the council would like to proceed with appointments is up to you. You can choose the manner and the timing of how you make appointments to the committees, including how you appoint chairs.
Okay.
That is entirely at your discretion.
Yeah, thank you for that, Madam Chair. I think that I would like for Kelly O'Donnell to be able to contribute to that discussion. I mean, if she's willing to. To me, it's kind of like jumping the gun because we need to appoint somebody, but we're selecting the chair in advance.
Madam Chair.
Okay, Member Sanchez.
Yeah, I think I agree with the other two members that there's not a rush. I think we can wait and see what the legislature does in the appointments, because business will continue. And,
So, Madam Chair, move to table this.
So you want, let's see what we're tabling. You want to table the governance committee chair nomination. Do you also want to table the committee appointments?
No, just the governance chair.
Governance chair, okay.
Election, yes.
Okay, do we need to vote on that then?
Yes.
Okay.
Yes.
And do we need a roll call vote or can we do it by ayes?
Roll call.
Okay. So we need, Member Tellis, you want to just sort of say you move that we table?
Yes, just move to table the selection of the chair until we have the full committee appointed for the governance committee.
Okay, for the government. All right. And do we have a second?
You don't need a second on a tabling motion.
Okay. Roll call vote then.
Treasurer Lori Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Tass.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Sommer.
Yes.
Mary Roman?
Yes.
It's nine in the affirmative. Motion passes.
Okay, thank you. All right, the next topic then is to appoint, on behalf of the council, to appoint Mary Roman to the investment committee.
Madam Chair,
Yes, Secretary.
just, just for clarification, how many people get to be on a committee? How many do we have for each one of these? And are there other people also interested in any one of those that are being presented today, or have they been asked?
Madam Chair, if I can handle that. We were notified that Kelly O'Donnell, Member O'Donnell, was interested in joining the governance committee. We haven't been notified of interest by any other members. You are limited to a maximum number of 5 for any committee because otherwise you would have a quorum of the council. If you do appoint Member O'Donnell to join the governance committee, that would put the governance committee at 5 currently, unless Chair Allen rolls off, in which case it would be back down to 4.
And then for Mary Roman, she would become on the investment committee as a council member.
That is correct, Madam Chair, and that would take the investment committee to 3 council members from the current 2.
And so, Madam Chair, 5 is the max.
Correct.
Okay, thank you. And did we know if anyone else was also interested, or at least in investments?
In the investment committee, we have not heard from anyone else interested. No.
Okay.
Madam Chair?
Yes.
I think that because of the tabling, I would hold off appointing anyone to the governance committee for the following reason. And that is, if some other member of the council would attend the meeting and there's 5 members, we got a quorum problem. So until we know the answer as to your appointment, I would suggest we just hold off on that decision. With respect to the appointment to the investment committee, Mary has been a very active member of that committee and does a great job. I don't think it creates a problem from a voting perspective to put her on that committee. And so I would move that we approve Mary at this time to be on the investment committee, Mary Rowan, and hold off on the decision with respect to the governance committee until we know your situation.
All right. Any other comments or thoughts? So
Madam
then,
Chair,
yes.
I'm happy to second Mary Roman's appointment, if that's a motion,
Okay.
her appointment to the investment committee.
I'm going to have Member Sanchez do the motion just for Mary, and then you second it, if we can do it that way.
Thank you.
I believe Kurt already made the motion.
He just made me.
Oh,
Okay. He made it.
All right.
And John Member Bingaman seconded.
Okay. All right. Roll call vote. All right.
Treasurer Laura M. Montoya.
Yes.
DFA Secretary Wayne Probst.
Yes.
Nick Teas.
Yes.
Catherine Allen.
Yes.
John Bingaman.
Yes.
Kelly O'Donnell.
Yes.
Alan Sanchez.
Yes.
Kurt Summer.
Yes.
Mary Rowan. I guess you went and voted.
Abstain. Abstain. Thank you.
That's 8 in the affirmative. Motion passes.
Great. And Mary, you've already been a real asset to the investment committee. So now you're officially on as the member of the council, but thank you so much for what you did.
Thank you. And thank you for your confidence, everyone.
Yeah. So now we'll go to closing matters. Is there any old or new business?
Madam Chair, if you do roll off, if the legislature does appoint a replacement for you, I just want to thank you for the incredible work you've done for the council, for all the years you've served, and for chairing the governance committee for all that time. So if this is the last meeting you attend as a council member, I just want to thank you so much for everything you've done for us.
Thank you. Thanks.
Madam Chair,
Yes.
I'm still unclear about the governance committee appointment. We had Kelly on there, and we're not going to move forward with that, or
We're
what?
going to wait until after. The issue is we can have 5 on a committee. If I'm not rolling off, then adding Kelly that would create the 5, which would mean no other member can come to a governance committee or it becomes a quorum. So what we did is we tabled waiting till your next meeting, the February meeting. We'll know by then whether I'm rolled off or not, and then move to Ed Kelly or
Okay.
anyone else that's interested to the committee. So we've tabled the governance committee appointments until after we know more about what I'm doing.
Okay, as I understand it, we have uh, the Treasurer Montoya, we have Kurt, we have Alan, and we have you. That's 4. If we added Kelly today, if she's willing, that would be 5. If you
We have
roll off,
we have Sanchez.
that's
Alan's,
what I said.
yeah.
That's what I said.
I'm sorry. Okay.
So we would have 5, and then if you rolled off, there'd be a vacancy.
But then the members can't join. What else can participate?
If there's 5, then until I roll off right now, it prevents other members from coming to the meetings, or we create a quorum and then that becomes a problem. So what we're waiting to hear is if I roll off.
What are your thoughts, Kelly? I'd like to hear from you on like what your conversations have been.
Yeah, thank you. Thank you. And Madam Chair, I'm obviously, I want to serve on the governance committee. I'd like to start attending. Well, I attended the last meeting, and I'd like to contribute. I mean, but I also will defer to the will of the council in terms of if you want to table that motion until the next meeting, that's fine too. I'm kind of puzzled by the idea, just the idea that we wouldn't fill a committee up to 5 members because another council member might show up. And I mean, I guess that logic is a little confusing to me. But I'm, again, totally open to the will of the council and certainly willing to defer this decision till next month.
Thank you.
So,
Any,
Madam Chair, there's 4 of us on there now. If we have another one, then at least we'll still have 4 if you were gone. So based on the recommendation of the Council Governance Committee, I move that the State Investment Council approve the following appointment to the Governance Committee, Kelly O'Donnell.
Second.
So did we vote before to table or
No.
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 Okay, all right, so that we can take those vote. Okay, so you want a roll call vote then?
Treasurer Laura M. Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes.
Nick Tass,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
Mary Roman.
Yes.
That's 8 in the affirmative. Motion passes.
And Madam Chair, if there is a vacancy, just want to, for the record, let the council know that I would be interested in sitting on that committee if there is a vacancy. Thank you.
Vacancy of what? Of the committee?
If you roll off.
Oh, if I roll off, you're saying you're interested in serving on the committee?
That's correct. Yes.
Got it. All right. That's it. All right. Thanks. All right. And welcome, Kelly, to the governance committee. All right. Anyway, back to any old or new business. Seeing none, any public comment that we have?
Madam Chair, not today.
Okay, thank you very much. Our next meeting will be February 24th, Tuesday. It will be theoretically at the governor's cabinet room. And you also got a calendar for all the meetings for the rest of the year. So please note those. So now we need a motion to move into executive session.
Madam Chair, pursuant to New Mexico's Open Meetings Act, NMSA 1978, Chapter 10, Article 15, and in accordance with the New Mexico Attorney General's current Open Meetings Act compliance guide, I move that by a majority vote of quorum of the State Investment Council, the vote of each individual member to be reflected in the minutes, the council enter a closed session pursuant to the exemption for limited personnel matters in Section 10-15-1 H2 for the sole purpose of a discussion relating to the annual performance evaluation and compensation of the State Investment Officer, John Clark. Only this limited personnel matter will be discussed in the executive session.
So we need a second.
Second.
All right, we'll go to roll call vote.
Treasurer Laura M. Montoya,
Yes.
DFA Secretary Wayne Probst,
Yes, with a friendly amendment / suggestion, Madam Chair, could we convene in about 5 minutes so that we can have a quick break?
Yes, I was going to announce that. And we've got some refreshments here too, if people want it. Yes.
I vote yes. Thank you.
Nick Teas,
Yes.
Catherine Allen,
Yes.
John Bingaman,
Yes.
Kelly O'Donnell,
Yes.
Alan Sanchez,
Yes.
Kurt Summer,
Yes.
Mary Roman.
Yes.
That's none in the affirmative. Motion passes.
Great. So 5 minutes, there's out this way are the restrooms, there's water and coffee and some treats in there, and then just come back in. All right.
I would just like to remind members joining us virtually that you'll need to sign out of this meeting and sign into the closed session Zoom meeting for the executive session. And then once that's over, please sign out and rejoin this meeting so we can continue our webcast.
Great. Thank you.
Thank you for the reminder.